The structure remains intact and sound. As you can see on the table, we've got 7 main asset classes, and these afford obviously the participants the ability to construct a broadly diversified portfolio. Now that's complemented with the target date funds, as well as a newer offering, the self-directed brokerage account at the bottom through Charles Schwab, and that is starting to see modest cash inflows quarter over quarter. As you'll notice, and this is a familiar theme year to year, the U.S. equity market segment continues to hold the vast majority of assets. In dollar terms, that's $1.4 billion, over half, about 55% of the total participant assets. Now, recall there were very strong markets in 2023, 24, and now 25, each of which saw significant double-digit gains to equities. So that's really continued to be the growth engine, pushing the balances significantly higher over the last several years. Next largest is principal protected. This is the stable value offering for those closer to or in retirement, ideally. Remember, this is somewhere between a money market fund and a more intermediate duration bond fund. It has that insurance wrapper that protects the principal while still offering an attractive interest rate. And lastly, the target date funds, which themselves have a lot of equity exposure along the glide path. So that's kind of the structure of the plan. If we look on page 19 real quick, we can see the sources of growth over the quarter. And it's also a nice way to visualize the investment structure as it's been designed for the participants. So you can see across those main asset classes we just touched on, what's on offer within each. Importantly, from a structural perspective, there's a nice blend of active management and passive management within the plan, has a big impact on cost that we'll turn to in a moment. The investment return column continues to be the biggest source of growth. Quarter over quarter, you can see that that was positive in aggregate and across virtually all of the offerings. And that was tempered a little bit by the net new investment. So that's cash flowing out of the plan, which is a fairly consistent pattern quarter to quarter. There's more money going out than coming in based on the participant demographics of the overall MDC. So all told, the asset value held steady at about $2.5 billion at the end of the period, and that was up over $123 million from this time a year ago. If you'll jump now to page 22, we do want to touch on the cost aspect of the MDC. This is always a very strong report card for the plan, and you can see we have costs for each of the options, but I'm going to take you down to the total line at the bottom. So the dollar weighted expense ratio of this plan comes in today at 25 basis points. You know, we know anecdotally from our work across plans that that is a low number. It sounds like a low number. When you compare it to the median of the marketplace, you can see that that comes in multiples higher at 0.81%, 81 basis points. So there's significant cost savings built into the offerings in the MDC, right? So as fiduciaries, one thing you can exert a good degree of control over based on your scale and oversight. And that's proving to be the case here. I always like to do a back of the envelope calculation, but essentially based on what I just described, that translates into $15 million a year that remains in participant hands, so to speak, rather than accruing to the investment managers in the form of fees, and compounds over time to their benefit, which can be a big dollar value over a working career. So that's the high level comments we have on the MDC. Everything continues to look sound in the sense that there are no missing pieces today, and everything meeting their objectives at a low cost. Any questions about that before we turn to ORP?
You continued your presentation, always positive. and then the thing you stick at the end, but we're pulling out more than we're taking it in, are we in good shape or not good shape?
The plan continues to be in good shape, more money going out in the MDC based on the participant demographics. So more people in or approaching retirement. That's fairly normal for a mature, stable plan. That there's nothing wrong with that profile.
And I asked this question several weeks ago, when we go through these periods of good rate of return on our investments, is that in any way related to the political, national political situation at all, or is that would just be a guess?
That's a trickier one to answer. I would say there are some policies that do have a positive impact on market performance, right? So potentially lowering interest rates could be an example. Favorable tax, could also be a tailwind to the markets themselves. So they could certainly have an impact, but don't themselves kind of explain all of the results.
So in the mid-year elections, if all that should change, would you think that will some way affect our investments?
At the margin, yes, a change in administration could have some impact. That's not our base assessment, but certainly there's the potential for that as the market tries to kind of assess what the outcome may be.
Thank you.
What about Wellington small cap? That one does not speak from personal experience with that. That's not done extremely
Yes.
well over.
That's why. Okay. I was wondering why.
Yeah.
Well, that is a great observation. Certainly one of the funds that we are monitoring closely given the recent performance shortfall. Although I don't have it in this presentation, we do have a little more detail in the defined benefit. Essentially what's going on is this market segment, you see the benchmark, the Russell 2000, this is small cap companies, has been one of the most challenged segments for active managers over the last year, really since April 2025, when the market bottomed and then experienced a very strong rebound. What rebounded, what did well in that environment was often what we call low quality. So these are companies that are unprofitable, highly shorted, heavily indebted. They're not attractive from a fundamental perspective, but they often can do well as risk returns to the market quickly. And then fundamentals eventually catch up and are rewarded over the long run. In any event, that's what did well. Wellington, as the investment manager, isn't really out there looking to buy those companies. But over the last year, because those did well, that was a real tailwind, headwind to their performance.
And the reason the index fund did well in comparison.
Exactly.
And if I could jump in there just a bit, in your big book, it provides the calendar year performance, and what you'd see is in 2022, when the index was down 20.5%, they were down 14.3. So they were 6% over the benchmark there. In 2023, they were at 18.14 versus 16.93. And then about the next year, 2024, at 10.10 versus 11.5, so offsetting the prior year. And then what we see in 2025 is really where the negative performance kicked in, up 2% versus the benchmark that was up 12.8. And as Alex alluded to, interesting phenomena, particularly in the small cap that we've seen this. In the Russell 2000, you have a good share of companies that are non-earners. In other words, they're the fundamentals that support active management, saying they're looking for cash flow, things that are tangible as opposed to speculation. And it's in this particular year that we've seen a lot of active managers underperform pretty significantly. And just by illustration, where that 2% return is in the 80th percentile, the index is in the 16th percentile. In other words, they're the index is beating 85% of the actively managed funds out there, and it's that. So certainly it's something that's pervasive, and we see it across the spectrum in small cap. And again, this is a period of time where when you talk to these small cap managers, they'll say they haven't seen the degree of speculation in a group of stocks since the tech bubble. So again, that's kind of a cautionary note. And as a final point, the Russell 2000, right, which are the 2,000 smallest securities traded in the 3,000 domestic equity market. If you were to go to another index like the S&P 600, which is also a small cap index, but to be included in their index, they have a committee that looks at actual earnings. So they've got an earnings component, and it's only generating half the return of the Russell 2000. So those are some kind of data points, but disappointed, yes. Surprised by the performance, not entirely.
Thank you.
Any other questions on MDC? Okay, then we'll turn our attention to the ORP in a separate book. And I'll jump right into page 2. In summary, although there are 3 different providers here, Corebridge, Voya, and TIA, that are active mutual fund platforms, they are all effectively designed with the same intent and the same look by and large as the MDC. In some cases, some of the funds may be slightly different, but from a structural perspective, from the asset classes that are targeted to be offered as the building blocks, very, very similar to what is done in the MDC from a high level perspective. So I'll comment mostly on the modest tweaks that really underpin the differences. Before I do, you can see this table on page 2 indicates that the combined ORP has a total participant asset value of just shy of $2.5 billion. And that's up almost 350 million from this time last year. Again, driven mostly by the performance of the markets and the funds, as the equity markets have done so well. And as we go down the page, Corebridge at 470 million, 20% of that overall pie, has about 50% of the participants invested in equity funds. That contrasts with Voya at 64% and TIA at 48%. So there are minute differences in the ways that participants are allocating themselves across these 3 plans, and those do have big impacts on their personal experience and personal savings journey, particularly when equities have done so well. Within each of these platforms, large cap US equity, so think either the S&P 500 or something benchmarked to the large cap growth index, is the first or second biggest allocation. It's been fantastic for each of the last 3 years. But when markets sell off and go back to like a 2022 market environment, that's when things would go the other way for participants. So that's all we really do want to say about the ORP without going into the details of each plan individually. As I mentioned, looking very similar to the MDC from a structure perspective, but happy to take any questions that the board may have.
Any questions? Charles?
Thank you, sir. The next items on the agenda are plan documents for both ORP and MDC.
Sure, I'll go ahead and cover that one. To start with, so as he mentioned, the next item is the plan document for ORP. You should have a copy of that in your materials. This, for the ORP plan document, is simply to reflect the upcoming increase in the employer contribution rate per the existing state law. And you can see the few changes, just updating those numbers throughout this particular regulation or particular plan document. And we'd like to ask for the board's or the committee's initial approval unless you have any questions.
Any questions? Do we have a motion to approve?
So moved.
Do we have a second?
Second.
Any other discussion? All in favor, by aye.
Aye.
Any opposed? Motion carries.
Thank you. The next one is the MDC plan document. And should you prefer that we go through it in more detail, we'd be happy to do that. Ms. Lee, of course, is here, as well as our attorney from Ice Miller, as we mentioned. But what you'll see here, and you should have a document with a summary and then a red line version in the document as well. You'll see a fair amount of changes are red, but all this is doing is to incorporate into the plan document the changes that hopefully will be put into place if the legislation passes, which is the board-approved legislation to add the Roth accounts to MDC as a result of previous changes in federal law, which will provide that it basically requires that the high wage earners, if they have catch-up contributions, they need to be a Roth or an after-tax provision. The legislation the board approved that's in the process now would add that. This essentially conforms the various provisions in the plan document to do that. There are a few very minor wording changes while we're at it, but nothing that's substantive. The main part is to reflect that legislation should it pass. In the event it doesn't pass, we would just simply withdraw the document. And with that, be happy to answer any questions or have Mr. Vetterli walk through it in more detail, or if you have any questions for our tax counsel. But if not, we'd ask for the committee's approval.
And with that, you're talking about the high wage earners, but this is really important for the lower wage earners, because contributing to a Roth at a lower tax bracket for folks that are in a lower tax bracket right now is really to their benefit over the handful of the high wage earners that are caught in that trap. So that this is, in my opinion, is very important.
That's a great point. It was the high wage earner part, I think, that was kind of prompted it, but this would apply to everybody. Yeah.
And there's no limit for, like you said, it applies to everyone.
Yeah.
And the limits that apply, I guess, are the same that apply to any deferred contribution. And transfers would be the same way.
That's right. Transfers, rollovers, all of those are addressed here as well.
Right. Any questions? Do we have a motion to approve? Do we have a second?
Second.
Any other discussion? All in favor, by aye.
Aye.
Any opposed? Motion carries.
Thank you.
You have any miscellaneous that you need to give us?
Well, I just have one miscellaneous update, and it doesn't really have anything to do with, the effectiveness of the management of the portfolio. But there's going to be a change at AB. They manage a global equity portfolio in the Voya ORP plan. Dave Douglas, their current CIO, is going to be leaving the firm. Klaus Engelman will remain as CIO, and they'll be replacing Dave with Rasmus Lee Hansen, which is their senior research analyst and portfolio manager. So just small changes at the top, nothing directly concerning the portfolio management of the fund. So with that is all I have.
Anyone have any other discussion for the Defined Contribution Committee? If not, we will stand adjourned. Turn it over
you.
to
I
Dr.
appreciate
McCoy
that.
for the Investment Committee.
I will call the investment committee into session. And Charles, I'll turn it over to you. If you'll wait just a second, I gotta get my pad and my pencil so I can jot down your remarks there. So I am ready. Go ahead.
Okay, well, good morning, everyone. I'm pleased to announce that January delivered solid gains across global equities, with emerging markets leading thanks to a slightly weaker dollar and improving earnings expectations in the marketplace. AI-related investments continue to be a powerful driver, though leadership remains narrow and volatility picked up around geopolitical headlines and policy uncertainties. In the U.S., the S&P 500 reached new highs, but the market is still sensitive to tariff discussions and questions about the Fed's future direction following the nomination of Kevin Warsh. Europe and the UK posted positive returns, supported by better than expected economic data, some easing of geopolitical tensions in Europe. Japan continued to benefit from AI demand, improving domestic conditions, though policy uncertainty and currency moves kept markets a bit choppy. Emerging markets were the standout in January. Performance has been a little more uneven in early February as investors look for clearer policy signals, in particular concerning China. In fixed income, government bond performance was mixed, but credit markets held up well, spreads tightening across regions. And early this month has brought a steadier note. Treasury yields have drifted slightly lower, and risk appetite has remained intact. So overall, for the first few weeks of the calendar year, it suggests that the market is still willing to reward good earnings growth, but that remains highly attuned, but the market remains highly attuned to spot policy signals and geopolitical developments. So for the month of January, for context, the S&P 500 returned about 1.5%. The MS PERS portfolio for January returned 2.7%. And the reason I'm giving you this context is sometimes we get the question that why don't you just invest all in the S&P 500? Well, the reason we don't do that is the S&P 500 isn't necessarily always the best performing investment. That's why we have a strategically allocated portfolio. So far for the month of February, the S&P 500 is up 0.5%, and the PERS portfolio is up 0.89%. So fiscal year to close yesterday, the total portfolio is up 12.06%. Now these are estimated numbers, unaudited, but they're close. So that is my opening remarks. I wish we could go ahead and bank those numbers now, but anyway. Our representative from Callan is here. John is going to take you through December performance from their executive summary.
Thank you, Charles. I'm going to ask you to turn your attention to the book labeled Executive Summary. And let's open that to page 4. So these are the Mississippi performance highlights, the one-pager that you can take with you for easy reference. Assets stood at $37.6 billion at the end of December, a decrease of approximately $1.8 million from the end of the third quarter. And as we look in a moment, you're going to see that we had substantial earnings in the fourth quarter, but also the distributions for the COLA, which was a big drawdown. Asset allocation was in line with the targets. We saw that fixed income was underweight a little bit, about 2.8%. Domestic equity was overweight by about 0.6%. So, but all within our expectations for the overall allocation, and we'll see that in a moment. The chart below, short-term performance for the fund, gives it by asset class, and the periods being reflected here are the last quarter in green, and fiscal year to date, and then the last year in sky blue. And as you scan across, you'll see that the total fund return is posted to the far right. But as you're moving from left to right, you see the equities, global equity, domestic equity, global equity, and international equity. You're looking at that blue bar for the last year. You see that international equity generating a return of about 34%. Well ahead of the domestic equity at 14.2. So here's the power of diversification that Charles was alluding to, that we know that non-U.S. equities compared to U.S. equities have been struggling for quite a bit to keep pace with the U.S. And then you have a year like 2025. Global equity, which is a combination of both US stocks and non-US stocks, about 64%, 65% US stocks in that portfolio, was up 21.6 for the year. And as you look to the far right, you see the 1-year return for the total fund was 16.4%, certainly an outstanding return. Fiscal year to date, that puts at about 8.1, and for the quarter, 2.9. Over the longer term, and we'll see these returns when we look at the total fund performance page, total fund has outperformed its benchmark for the trailing 5, 7, 10, and 15-year periods, with annualized returns of 7.9, 10.7, 9.6, and 9% respectively. So again, when you're looking to beat your actuarial assumption at 7%, returns like this are critically important. So what's taking place in 2025? The word is resilience. That's what we saw from the marketplace. We saw the policy concerns, government shutdown. We've seen wars. We've seen constraints on supply chains. Despite all the drama, policy changes, if you will, Liberation Day, the retractment, the tariff situation, what we've seen is that equity markets have seemed to persist and to shrug it off. The weakening dollar certainly has been a help for U.S. investors investing abroad, of which this fund participates, to the tune of about 10, 11%. So again, that's not even taking into account what you earned abroad. It's just repatriating those euro back to U.S. dollars gives you a return of about 10 to 11%. We've seen consumer confidence wane. There's certainly concern, but there's also, as I touched on when we talked about small cap stocks, a certain exuberance, right? We talked about the Magnificent Seven stocks. Interesting case. When we look at the Magnificent Seven stocks that have been driving the market, it's interesting to note that over the year 2025, only 2 of the 7 have outperformed the S&P 500 average. In other words, what we've seen is in a very strong concentration of these stocks driving the market for the last few years. In 2025, we've seen a broadening of the market. We've seen small caps, albeit trading below large cap securities. Certainly, you have a lot of names that the disparity between large and small cap is not as great as it was in prior years. So small caps did come back, and certainly in 2026 have generated some pretty strong returns. But suffice to say, what we've seen is the concerns about inflation being sparked by the tariffs, et cetera, has not really come to fruition, right? So inflation has been fairly benign. We've had 3 cuts in the Fed. The Fed's cut rates by about 75 basis points. And again, the idea here is they've got a dual mandate: stable prices, full employment. And what we've seen is while the job front, the unemployment rate, even at 4.4%, is relatively modest by historical standards. So again, the idea here of them cutting rates was to spur employment, to focus in on the labor situation rather than inflation. Inflation numbers, again, yes, they've got a 2% target. Inflation came in December at 2.7%. In January, it was 2.4%. So again, there's a lot of things working in the economy. GDP surged in the second and third quarter. In the fourth quarter, the numbers that were just published for GDP, which is a benchmark for the health of the economy, came in at 1.4%. So slowing down, but the idea here is that there are a lot of things working. Real estate is bottomed out. We're seeing a resurgence in some of the sectors there. And if you turn to page 10, you can see some of the strength of some of these equity returns by comparison. So on page 10, we see the S&P 500 was up 18% in 2025. So that's coming back off the back of 2 consecutive calendar years where we saw returns in the S&P 500 exceeding 25%. Keep in mind, very long term, the S&P 500 going back to 1926 has generated about a 10% return. If you look at the S&P 500 for the last 10 years, 14.8%. So again, strong equity markets. Highlighted in orange is the Russell 3000, which is a broader benchmark than the S&P 500. It includes small cap stocks at 17.15. Russell 2000 small cap stocks up at 12.8. Non-US stocks, these are equities, at 32%. Emerging markets at 33.6%. And non-US small caps at 29%. You have exposure in each of these categories that you've benefited, particularly in a period where we see that non-US developed equities up 32% versus 17% for the US. Fixed income also generating very strong returns. If we look over the 1 year period, a 7.3% return. Where they were really challenged was the 5 year number, which includes that 2022 where it was negative. So the 5 year number for fixed income is negative 0.36. This is where active management really paid off, because in fixed income, your active fixed income managers over this 5 year period were generating positive returns. Real estate, we see that over the last quarter, up 1.2%, about 5% on the 1 year basis. And then Cambridge private equity, we saw over the 1 year up 9.5%. Again, that benchmark is lagged by a quarter, and we see over the last 10 years, it's generated a 13.4% return. Long term, what we expect from private equity is to outperform the public equity markets by about 2%. And when we look at your performance, you'll see you actually earn that. Any questions regarding that snapshot? Okay. Page 12. This is a histogram that just kind of illustrates, if you take all the calendar year returns of the equity markets and you go back, this is going back 235 years, but suffice to say the more recent periods are more representative. But you can see how strong the recent returns have been if you look to the information to the right. The downturn in 2022, as you recall, that was really sparked where we saw both negative equity markets and negative fixed income markets, because what we saw was COVID, particularly out of China, constraining supply chains. We saw the inflation had spiked up to 9%. The Fed had taken rates, short-term rates, from 0 to 4%. And that had an impact of stifling both returns on the domestic and the equity side. But since that point in time, we saw a resurgence. And if you look at in 2025, we had a 17.9% return, 24, 25% return, and 2023, 26% return. So again, good news from the markets. Turning to page 13. What is this telling you? Oh, I'm sorry.
Hold on just a second.
Yep.
There. Last time we met, our actuary talked to us and gave us a risk figure. And I can't remember precisely what it was. But my question to you is this. We had a -4 in 2018. 4 years later, we had a -18. Since 2022, we've had 4 good years of return. Now, just based on that short historical period, it's about every 4 years or so that we have a downturn or a readjustment in the market in some manner. So do you have anything that goes back a little bit further or off your mind? Is it on average every 3 to 5 years that we have an adjustment and there's a negative return? Do you have something off the top of your head? I'm not holding you to it.
Sure.
It just seems like that's what occurs here. Is that?
Yeah, I think it's safe to say that there's typically a correction in the markets once or twice every 10 years. And depending on how robust your boom is, that may go into playing how severe the correction is. So in other words, if you had pretty benign, steady markets, single digits or low double digits, then your downturn might not be as extreme, right? But a lot of these are very episodic. Something like COVID. I mean, that is a worldwide phenomena that is along the lines of like a World War I or II or some world event like that, which is uncharacteristic. We don't know what it is, but we know every decade. So when we do our projections in terms of looking out 10 years, there's always an event like that, because when we do the modeling, those years are in there and they surface. Yeah.
I don't know precisely where I need to say this, but right now we're in the midst of the legislative session, and their bill is still alive. I believe it's still alive for 500 million this year. And if since 2022, if we have another correction, that 500 million is not going to be enough to take care of the issue. I mean, we're getting further. In other words, whenever the board suggested that the contribution rate go up to in the 20% range, if we had been getting that $500 to $600 million a year from that time, we would have had very good returns, Charles, would we not have, over the last several years? And that would have been a lot of money coming in, but every time we're underfunded, we're losing revenue, because 55% approximately of what we pay out comes from investment returns, right? I just want to say that we need to keep the pressure up on the legislature that what we're getting is not going to help when we have this downturn, whether it's 2% or 8%. It's not going to be enough, and they're going to be faced with, and the system will be faced with difficulties here. I'm sorry to interrupt, but that was just on my mind, because we need to keep that in front of the legislature. Okay, thank you, John. Go ahead.
Absolutely. On page 13, this is just telling you how expensive is the U.S. market. We talk about the exceptionalism that it's experienced, the U.S. equity markets. And one metric is the PE ratio, which tells you the price for earnings. And when something is performing particularly well, the price goes up and the earnings, maybe even if it's flat, is going to go up in terms of a ratio. So what this is telling you is, like, looking at the last 30 years, how expensive is the U.S. market? And we see that the price earning ratio is about 22% of forward earnings, projected earnings, versus 17% for the 30-year average. So you see that one standard deviation each way picks up about 96% of the observations, right? So it's a pretty good collection. And you can see that the U.S. market is priced pretty much for perfection. Things have gone well. Certainly, the AI phenomena has really taken off. And now you go through when something is priced, high priced, everybody thinks everything is rosy, and any slippage, any event might derail the effort. Now, does it derail it to the bottom? No, but the idea here is that what we can expect is volatility. And that's certainly given the price of the market. Non-US markets are not priced as highly, even despite the fact that they've generated strong one-year return versus US. And small cap stocks have been, again, lagging, so they're a little bit more affordable. But that just goes to point out that what we've experienced, it's a natural occurrence that the price of the overall market is going to increase. So let's turn to page 14. These are US equities, what's worked and what hasn't. And what's interesting in the fourth quarter, we saw that what really did well were communication services, and what's included in there, think Google, up 28.8% for 2025. What about healthcare? Weight loss stocks did particularly well. So HCA did very well. So those stocks were up 11.8% for the quarter. And we see information technology was up only 1.4%. So that, to my point about the market is broadening out, that we see that it's going across the sectors. The two that declined, again, these are publicly traded securities in the S&P 500, were real estate and utilities. And why are they down? Because the expectation is long-term inflation may be on the horizon, and these are more interest rate sensitive sectors of the economy. Utilities, again, yield plays. So what you get today versus what you get down the road. But suffice to say, equities have performed strongly and continue to do so. When we turn to page 18, we see non-US stocks. And the idea here is that if you look at page 18, for the quarter, all of these non-US stock indices, with the exception of China, were positive. And if you look over the 1 year term, you see even China was up 31%. So again, looking across the board, we see a lot of green from non-US markets. And again, we see that on page 20, Fed cut rates 3 times in 2025, yet the Bloomberg aggregate, which is the broad index, was up 7.3%. So again, idea here is that as the Fed cut rates, it's more stimulative, but still, even with the increase in the tariffs that were passed. Now, what does the rollback mean? What is the intention? Remains to be seen, right? Because it's late breaking news. We know that the Supreme Court stepped in and validated some portion of the tariff program. But again, there's other avenues that are going to be pursued. So I guess the idea here is, what's the best remedy for situations like this is diversification, and that's why we have a broadly diversified program rather than taking knee-jerk reaction and stay the course, right? We know that over the long term, there'll be fits and starts, there'll be news, there'll be good news, there'll be bad news, but the idea here, diversification is best for the long-term performance. Any questions on that? Okay, let's take a look at your portfolio's performance. Let's go to page 32. And we see that the way to read this chart is right to left. This is showing your beginning value at 37.6 billion at 9/30. Our investment return was a little over $1 billion. And the money coming out for the quarter was about $1,068,000. So again, the differential there is, while you had a strong quarter in returns, about 1.8 million negative due to the distribution, giving you an ending value of about 37.6 million. Any question about that? Should be no surprise that when we see that this is a big number every fourth quarter of every year. Turning to the total fund performance, this is the total fund summary dashboard. So there's a few pieces of information here. What this is designed to tell you is, how did your fund perform in absolute terms? How did it perform versus your benchmark? And how did it perform versus your peers? We look at, for the last quarter, 2.86 versus 2.6. If you look at the blue number, that's telling you is in the 8th percentile, right? Which means that you outperformed 92% of the funds in this universe. What's in this universe? Public funds over 10 billion in assets, about 65 to 70 funds, depending on which year. If you go back 15 years, it's 65. If you look the more recent, it's 70, okay? And as you look over the last year, you see up 16.38. The benchmark was up 16.38. and that puts you in the 7th percentile. So in line with the benchmark, extraordinarily strong absolute returns and top decile performance. Over the last 5 years, you see 7.9% versus 7.5 for the benchmark, and puts you in the 51st, so like right in the middle, the median. But if you look longer term, 7 years, 1065 versus 1034. Over the last 10 years, generating a 9.6% return versus 9.2 for the benchmark, and that puts you in the 9th percentile, and over 15 years, you're in the 14th percentile. So you're outperforming 86% of your large public fund peers, and you're beating your benchmark, and you generated a 9% annualized return when your actuarial assumption is at 7. So again, those are positive keystrokes. Turning to page 34, it provides information, takes snapshots on a calendar year basis. And what you can see is that the strength of the performance, 2020 outperformed, 2021 outperformed, 2022 outperformed. And what's important in 2022, when the benchmark was negative, you outperformed in that negative environment. In 2018, when the benchmark was negative, outperformed it. So again, the idea is mitigating and performing stronger on the downside. But suffice to say, very strong absolute returns. We touched on an interesting phenomenon. So what hasn't worked? Well, in this environment, small cap, mid cap stocks have had a hard time, particularly as the lower quality rally, if you will, has outperformed. And again, we've seen, I can't remember a year where small cap, mid cap managers have performed so unfavorably versus their benchmark. And I think, not to call out a particular firm, but DFA was an example where they underperformed the benchmark by a pretty big, like 4%, but yet they were in the 38th percentile, outperforming 60% of their funds. That just gives you some sense of how benchmarks in certain periods of time are not the end all and be all. So they also have their biases, and it's the lower quality component of those small cap benchmarks, the biopharma that did particularly well, that is really lending itself to overall performance. But on a total fund basis, the diversification in play and the strength of the overall performance really speaks to itself. So happy to take any questions.
Am I just dreaming? Did not in the years past or months past, whatever, we were told that we were in the 98th percentile in our investment as opposed to our contemporaries, and now you're saying we're in our 80-something percentile? If I got it confused?
Maybe a little bit. What I would say is, if you look compared to your peers, if you turn to page 34, and this gives you a year-by-year snapshot. So 2025, see that blue 7? That's saying that you outperformed 93% of your peers. You're in the top decile in terms of good performance. In 2024, you outperformed 73%. 2023, you outperformed 73%. I'm sorry, 63%. And then 2022, relative to your peers, you did suffer, right? You were in the 95th percentile. So that's bottom decile. But then you can see as you go across the board in all of these positive years relative to peers, you were in the top quartile for the most part. So again, outperforming at least 75% of your peers.
The 2 years where we aren't, I think, has to do with our weight to
Equities.
To equities is not.
That's
I think
correct.
that's why the others are like they are.
Yeah.
And
other
in
years
the
we
good years are
outperformed.
that good.
That's it. And to Dr. McCoy's point, like how often do you have a downturn, and do you allocate for protection just in the downturn and not fully participate in the upturn? Or do you have a portfolio that's going to generate stronger returns 4 out of the 5 years? Yep. Does that answer your question? Thank you. Anything else? Thanks, all.
That complete item number 1?
Yes, sir. The,
And let me just say a few words as they get ready to go through the manager fee review. Callan and Charles, of course, are going to go through that in more detail, but just want to say, I think what you'll find is that we compare very favorably to other similar public pension plans, similar to PERS. I think you'll see 0.31% overall as the investment expense ratio. Or to say another way, as Chairman Benson often says, that's 31 cents for every $100. So relatively low in that respect. And just want to say, and to remind you, of course, you know that investment fees are often a topic of importance and of interest to the legislature and others in the, throughout the state. And when we finish this, in addition to, of course, doing this in the public forum, we'll make sure and call their attention to it to provide this. This came up in a question and through a question in the select committee over the summer. And then the occasional couple of representatives have asked me or asked us about it, and I've let them know, of course, we do this periodic fee review and that it would be upcoming. So again, in addition to this forum, we'll bring it to them or their attention. And then what we have already started to do and will continue to do, you'll see as you go through each one that the majority of our managers are below the median. But for any of those, there's just a few that for whatever reason might be above that. We'll follow up and make sure that there's a good reason for that, or use that to negotiate fees downward, which we've already done and have some results of that. You'll also find that in some cases, even though it may be above the median, which again is the rarity, only be a few basis points difference. So just wanted to point out that certainly appreciate the effort ongoing in monitoring fees from the staff and the consultants. And I think that while there's always room to improve, I think that the membership and the citizens can certainly take some comfort that the staff and most certainly the board, as well as the legislature, is monitoring the fees and continue to do so to make them as low and appropriate as possible. And again, we seem to compare very favorably to other public pension funds similar to us. And so I'd be happy to answer any questions. Otherwise, we'll turn it back to Charles and Callan.
The only thing I'd like to add to that, because he did a great job going over that, is that some of these asset managers that do have, that do show relatively higher fees, a lot of that is due to the uniqueness of what we're asking them to do. One that I'd like to point out is SIT investments. They're being compared against a benchmark that's made up of mainly government short-term investment funds. Because of what we ask SIT to do, we ask them to achieve a greater return than what we could get in just general money market funds. So what they do for us is they manage long-term assets to a short-term duration. This account was basically needed to help us manage the huge draws that we have every year for our lump sum COLA payment in December. So basically, when we initiated this search to find a manager that could do this for us, most of the funds that we reached out to asking if they could do this, they declined. It was just something that they didn't want to take on. So in that case, it's a very unique fund, and they're doing something that there's not a whole lot of firms out there that either could do it or were willing to do it. So just to kind of give you a little context around some of these managers. So anyway, with that, I'll hand it over to to Alex, and let him take you through the Callan study.
Thank you, Charles. And so this is in a separate book by itself. I'll jump right to page 5 to reiterate. We'll take a first look at the total fund. So that's the PERS plan in aggregate and how its cost compares to other public pension plans. And then we'll touch on, in part 2, the investment managers themselves and how they compare to their similar peers. But please ask questions along the way if you have any. Happy to dive in deeper where necessary. And page 5 just kind of covers the background of the methodology, the approach, the reasoning for this study. I'll call out kind of the key important information here. The second bullet talks about the data source. So there's a database that we utilize that covers 230 state and local pension plans across the country. That data set represents 95% of pension assets and membership out there. So it's a very robust data set. Essentially, every type of plan is in there. Big, small, lots of external management, internal management. All the different approaches are really encapsulated in this database. Importantly, now at the bottom of the page, one thing we do is we curate the data set a little bit to give us better context, better comparisons, right? So we do want to filter out some of those plans that are much smaller than you, who aren't pursuing as similar a strategy or have access to the type of strategies that you might. And then additionally, because there are private markets as part of PERS strategy, on a secondary basis, we also want to put that as a qualifier against the database. So look at plans of similar size that also have private markets. And that's important because private markets come with higher cost, generally speaking. So that's a better apples to apples comparison at times. But that's the background on the study. This is a periodic check we do about every 2 years. So the latest results are on page 6. And you heard some of these numbers, and I'll just reiterate. The source for PERS was the latest ACFR. We're using the 2024 annual report because that matches up with the database. It doesn't yet include fiscal year 2025 numbers since we're so new into the new year, right? But so we're comparing similar time periods. And for fiscal year 2024, you can see that 0.32, 32 basis points, that was the all-in investment expense of managing PERS assets. The chart on the right shows you how that compares to the database of public pension systems of similar size. In other words, those greater than 10 billion in assets. So you can see that orange dot is where you sit pictorially. What I think we care more about is the 70 number. That's the 70th percentile. In this case, a higher number is better, meaning lower cost. So the PERS system, based on this analysis, very cost-effective, lower cost than 70% of these other public pension systems. Now that's the cost piece. We saw in the prior performance review that the returns have also been very, very good on their own. So I think when you consider those in tandem, the results that we've gotten from our assets at the low cost that you've achieved that, I think together those provide a really compelling picture. Some of the pension systems of similar size in this database are going to pursue a strategy that has much more what we call in-house management. Here at PERS, almost all the assets are managed by external advisors. Some other systems do that in-house. That doesn't mean that their results are superior, but it does mean often that can come at significantly lower cost. So it's important to note that those plans may be in here, and even including those lower cost plans, PERS still looks very competitive.
And by saying lower cost, you're just making lower fee cost because you're not factoring in their personnel costs.
Exactly. We're just talking about the investment expense right now.
Right. These are just for external costs, and some of the pension systems that manage assets in-house, it can be kind of hard to determine exactly what their cost of managing assets are. So it's a little harder to do that comparison. But I think this comparison's good to show where we're at in an unconstrained universe. The only constraint is size. So regardless of how they approach managing their assets, we still show very competitive.
And I just want to make one point as you're reading this graph, that 0.32, that's not 32%, that's 0.32 of 1%, okay? So, again, very low overall fee ratio.
Right. As we heard from Mr. Higgins, I believe by way of Mr. Benson, 32 cents for every $100. It sounds like a very good way to quantify that actual cost. I like that. And on page 7, we'll look at the results when we further constrain the universe. So this now is plans of similar size, those over 10 billion, and those that also have an allocation to private markets. So think private equity, private credit, and the like. Pursuing a much more strategy akin to what we do here. In our view, a good apples to apples comparison. As we would have thought, given the higher cost associated with private markets, PERS looks even more competitive against this database. So you can see you drop right to the border of that third and fourth quartile, right? 75th percentile. So now more cost effective than 75% of the universe here. And to put that in perspective, that's 73 plans across the country. So it's a pretty robust data set. Any questions on that information?
One of the questions that I get asked from time to time is, do we not ever use any Mississippi vendors or management firms to handle this, or are there not any available?
It's always open to everyone. When we do a search, if there is a Mississippi firm that is capable of handling the volume of assets that we have, because most of these funds are at least $250 million, which can swamp a lot of smaller asset management firms, which could cause them, problems in managing assets of these size. But when we do a search, it's open to everyone. And if there's someone that is available, we always, look at them.
But most likely there would not be a Mississippi firm large enough to handle
I can't necessarily say that. It's just that we haven't found anyone that has been able to handle it yet.
Thank you.
One thing too, this may be a good time for me to mention something that I wanted to relay as well. As he said, it's always open, of course. But one of the things we're going to be doing in the future is on our website, right under the request for proposal link, we'll be putting a link for future manager search opportunities. And so should there be any local firms, they'll certainly be able to apply, and we'll definitely consider them, for sure.
And I would say Callan's got an open door policy. So we think we capture most of the viable candidate investment management firms throughout the country. But again, transporting data, just populating our database, there's no charge in connection with that. So that's one way when we're going through a search, each search is de novo. In other words, we don't have a buy list that if you're not on it, you're not considered. Every time we do a search, we're opening up all the viable candidates in our universes. So that way we avail ourselves of, we think, the broadest opportunity set.
One final comment before we look at the managers themselves. On page 7, that final bullet, the bottom left, shows the management fees, investment management fees for fiscal year 2025. You can see they dropped marginally to 0.31% versus 0.32%. I say that more just to reiterate there is consistency year to year in the cost with PERS. So it hasn't varied dramatically, has stayed, very competitive, and staff, together with Callan, always looking at ways to make it even more so. If you'll turn your attention to page 10 and 11, as we just covered, obviously at a total level, PERS is very cost effective. So where is that coming from? And 10 and 11 kind of show the cost for each of the underlying investment managers themselves. We're going to only cover 10 and 11, but all the pages that follow go into the detail for each of these funds on their own. Ideally, we would want everyone to be in the left side of this table, the fourth quartile, the lowest cost. And in fact, PERS is actually pretty close to that already. But we know that that's not always going to be the case, and there are other considerations in terms of the cost associated with managing some of these products, and we'll call that out in a moment. But the vast majority are in that fourth quartile. A couple others are in that third quartile, so also below median. This is where we want. And only a handful are slightly above median, with 3 that are in that first quartile, that highest level. That's the area that we spend the most of our focus. And I'll start with Eagle Capital at the top. This is a manager that historically, has been at the higher end of the marketplace in terms of, the strategy it manages, large cap, core equity. But over the long run, they have proven to deliver return results that far outweigh the benchmark. So with a sufficiently long-term view, they more than compensate PERS for the cost that they charge. To put that in perspective, over 21 years, they return 12.5% per year, whereas their benchmark was at 10.95, call it 11%. So even after paying for their higher fee, they've added significant value over that long-term time frame to PERS. Even over 3 years, it's been a choppy market. They haven't always hit their number, but over the last 3 years, a similar story. They're up almost 27%, the benchmark up 23% per year. So while we don't like a manager who's charging higher fees, we do often need to bring into the discussion and assessment the performance results that they're able to deliver and kind of evaluate those hand in hand. So this is one where that remains to be the case. Again, staff, Callan, independently and jointly trying to get them to lower that as the scale grows. Now, if we look at another manager on the page, Riverbridge, this is one that's in that second quartile, so indicating it's above median, but when we dig into the data, we see that they charge 0.75, the median is 0.74. So in this universe of managers, the distribution of fees is razor thin. It's very tight. They're 1 basis point off from the median, so they're very close. We do expect, or at least hope that, over time that they can get below that number, but it's already a lot closer than, for example, Eagle, where there's a much larger distribution between what they're charging and what the median is.
And I can say that we've been in discussions with Riverbridge, and they have agreed to lower their fees. So we're currently in process there.
On page 11, just looking at the rest of the managers, there's a similar story with Marathon. At 58 basis points, 0.58%, they're fairly close to the median at 0.51. And I believe there's already discussion about moving that fee schedule lower in favor of PERS as well. So you can see a lot of this work is already underway. This benchmarking helps support that, as does the ongoing outreach of staff and just the overall growing scale of PERS itself. Now, if you go to SIT, just under fixed income, Charles made some comments on this manager already. Fairly new, highly specialized. They run a very customized portfolio on behalf of PERS. They were hired to do so. And part of that is managing the liquidity and the annual COLA payment every year. So we think this was a great add. Because of those attributes, it comes with a little higher cost to do that. But again, when you look at this universe in the back of the book, the median's at 0.14, they're at 0.17. So they're very close already, although this suggests that they're slightly on the higher end. But we think given kind of the custom nature of the mandate, within reason. And then same thing with Wellington and PIMCO. You'll see at the bottom of the page here, these are emerging market debt and global bond strategies. Very close to their medians, just slightly higher, but managing much more complex global portfolios that arguably take more resources than some of the other strategies and are more specialized by nature. So that's why they show a little higher cost. But that takes you through all of the investment manager strategies. I think the high level takeaway is that, as you can see from the charts, the vast majority of the strategies skew to the left, which is where we want them, ideally in that fourth quartile. Only a few are on the other side, the right side of the page. And as you can tell, a lot of these are being addressed real time with beneficial results to PERS. So happy to take any questions the committee may have.
Am I remembering correctly that before there was more active management 5-10 years ago than there is now, with some of these moves to Northern Trust and some of these that were really just lowered because of the market, because of equities, U.S. equities? Is that accurate to say that active management has decreased here versus passive?
We did go through a period where we were moving more towards, passive strategies. We did, for fixed income, a couple of years ago, we moved away from passive strategy and fixed income because there's actually a huge benefit to active management in fixed income. So we didn't feel that we were actually getting benefit in that space. But you're right. I mean, we did move a fair amount to passive strategies, but where active strategies still make sense, we focus energies there. And then here just recently, we've been looking quite a bit at quantitative strategies that are able to give us active exposure at prices that rival what you pay for just a passive strategy. And, two of those recent were PGIM and Northern Trust in their quant strategies. So we're always looking for ways to, kind of wring this wash towel to get as much water out of it as possible. But the focus is, as far as we're concerned, the focus is always, how do we get the best returns, all right? Then we look at, okay, how do we get the best returns at the best price? And that's what we do. That's always the way we approach it.
So if there's been a shift, it may have been away from equity, U.S. equities, for instance. But those are real efficient types of investments compared to fixed income, where when they're less efficient, you can find deals, basically. So you use those as when they're specialized markets or whenever they're not as efficient of a market. Maybe that's where active management is usually looked at.
Yes. And you're right. Where markets tend to be a little less efficient is where managers have a better opportunity of achieving outperformance. So, and for instance, we don't have any passive investments in emerging markets, whether it be equities or fixed income, because those markets, there's a little less information available in some of those, on some of those companies. So there's a lot more work involved. So there is potential for, getting, outperformance there. So, but again, our focus is on finding managers that are able to, or their potential to achieve outperformance is high. And then we look at, okay, how do we do it at the best price?
It also probably doesn't hurt when negotiating fees. Is Marathon the one that was in a little trouble a couple of years ago with performance? Am I remembering that correctly?
Well, Marathon,
They the ones on the watch list?
it's a little higher volatility portfolio. But Marathon, they've done a very good job for us. Now, we were in discussions with Marathon and what they, because they have most favored nation clauses in their agreements with their clients, what they were able to do is add another tier bracket for us, which, you know, will bring our overall fee down, and that agreement is now sitting on Mr. Higgins' desk for signature. So,
Hitting on Mr. Higgins.
well,
Thank you,
it's, we've all been extremely busy, and I just put it on his
You
desk
don't have to make
yesterday.
excuses for him.
I was about to say, it was just yesterday.
It was just yesterday.
Prioritizing the board meeting.
Thank you, Mr. Nielsen.
Charles, you mentioned, active, passive, and then you said quantitative. What exactly is quantitative? I mean, what leaps to my mind is that's more machine driven. So just talk to me about that. I don't.
Yeah, it means a lot of different things to different people. Some quantitative strategies, they use the machine to help, you know, kind of funnel their search, and then after the machine funnels the search, then they you know, employ, you know, your standard, research-based review of those assets or potential investments. But the ones that we've currently added, it's all algorithmic machine run programs that these machines are able to review every single day thousands of companies. You know, that being able to do what a team of investment advisors would take them a month to do, these machines can do in a day. And they can do it very efficiently, and that lowers the cost.
Okay, that brings me to my next question. Are the algorithms AI written, or are they written by humans? Because that gets into
Yes.
where I want to go. Yeah.
Each of the, like Northern Trust and PGIM, they use AI, but it's in-house generated AI. It's not an off-the-shelf. They're not going out to Microsoft and saying, "Hey, Copilot, design a program for me to manage assets." They're not doing that. They're developing their systems in-house. It's proprietary and extremely secret, and they hold it very close. So it is a form of AI, but it is not ChatGPT.
I was just wanting to know how much we were allowing the machines to do it without verifications for human instructions there. I mean, that's above my pay grade, and I probably won't ever understand it or know when it's happening. But
even though that these two new portfolios rely heavily on, you know, the machine's production, there is human, you know, overview to make sure that the machine's not pushing portfolios out of bounds, or, you know, meaning weighing it too heavily in one company or sector. But it's a tool that's finally matured, that's allowed asset managers to find specks of news very quickly.
I can understand. I know that, machine driven is not a unique thing. It's the AI which allows the machine to develop its own and are not under the direct instructions of programmers.
Right.
So
Well, these aren't these AIs aren't developing their own. It is human-developed systems, but the systems are smart.
Mr. Chairman, just an opinion thought. As we ask the legislature to infuse more and more funds over a period of time, that if our portfolio begins to go through some troubled times, if that happens, there would probably be more eyes looking as us as to our fees and expenses related to them having to put money into it. So I'm sure we can have good answers as to why we, in some cases, have some expensive people who handle some of this. Just a thought.
I think that I, as a board member, when I am presented with that, I share with the people at Hardee's that ask me that question. I tell them, the legislature doesn't pay for any of the expenses of PERS out of the general funds. We fund our own. And so when they're questioning what we're spending in-house and are directing toward that. So we're the only agency, I believe, that is funded that way. Ray, would that be correct?
In the context of what you're talking about, we're the only pension funds. I'm not sure of the exact special fund nature of all funds, but your point's still accurate and well taken that it comes out of the fund.
In another life, in dealing with receiverships, we could find a law firm that would charge $100 an hour and couldn't spell receivership, whereas $400 to qualify to do what needs to be done. So sometime when entities have only part of the information, they see that $100 as opposed to the $400.
Well, I think we've got good information right here to help.
Good. I think so too.
Yeah, I'd like to add,
Just a thought.
in that case, taking Eagle Capital Management, over the last 3 years, we paid more to have Eagle Capital manage our assets, all right? We could have paid less and put them in the S&P 500, which it's benchmarked against. But in paying less, we would have given up 3% a year and excess returns to pay less. So sometimes paying less doesn't make sense.
My point.
Mr. Chairman,
That's Commissioner Graham, yeah.
Yes, go ahead.
following up on some of the conversations that happened this summer, I wasn't at the hearings, but I know Mr. Higgins gave us a report and some of you all attended the hearings. There was some, at least, general discussion about having more of the investment activities occur in-house, or maybe some other jurisdictions that do that. Have the board or the staff ever looked at whether or not there would be any cost savings or any feasibility of doing additional investment activity in-house?
Well, from a staff standpoint, that's certainly something we can look at. There hasn't been a formal analysis or a business case scenario or any formal review of that nature, but that's certainly something that we can look at. I would just say that's something that would take a little time and would not necessarily happen overnight. We've got to be careful to maintain the performance of the portfolio. And of course, one of the first steps in that, I believe, should that happen, would be some more PERS administrative independence, particularly as it relates to personnel board rules and fall under that and so forth. But with that said, it did come up a little bit. We've not done a formal review or analysis of that, but we'd certainly be happy to if you like, or at the proper time. And then related to that, I think Charles as well as Alex may have mentioned that in the review they did and some of the analysis, it did reflect some systems that had more internal management, and PERS still compared favorably with that in mind. But so great point, great question. Be happy to follow up on that further or speak to it more.
And when you say compared favorably, in what regard did they compare favorably? Are you talking about expenses or returns or both?
This morning was mainly about expenses. I don't know if Alex or John, if you want to recap that, but I think the point he touched over quickly was that, in the peer group, right, in the data set, there were some that had internal, management, and then we still compared favorably as it relates to the expense review we were doing.
Okay, I missed that part of his report. Thank you, Mr. Chairman.
Anything else on this particular section, Charles?
I have nothing else to
Other
add.
questions from board members? Okay, then I guess we'll move to item number 3. Is that correct, Charles?
The next item on the agenda is new investment to value-add real estate. I'd like Jason Clark, that oversees our specialty investments, our alternative investments portfolio, to come up and take you through this document.
While he's getting seated, I want to thank Colin for their work on the management fee. And I think that, you know, the ramification of number of employees, when we look at the researchers, the analysts that are all employed to managing in-house, just from my perspective, I would see that it would be a significant increase in the cost. Now, I don't know how that compares to what we're paying, but just in employees to handle it, and everything that goes with an employee, you know, all of those things about where do you house them, how do you furnish them with the tools, the computers, all that sort of stuff. So that would be an extensive study. I certainly don't object to that, but you know, I think that it is something just to alleviate and maybe do our own due diligence. We could look at that in phases and just see what it would take at some point. So, okay, we're ready to go ahead now. Thank you.
Mr. Clark? Thank you. Good morning.
Morning.
You may remember that in December, at the December Investment Committee meeting, we proposed a search for one or more new value-add real estate managers. Today, I come back with the results of the search and 2 managers I think you'll be impressed with. Both managers, top quartile performers. They're highly complementary to the existing PERS real estate portfolio. As you may remember, value-add real estate strategies aim to generate returns above core real estate by improving underperforming assets through physical updates, operational efficiencies, and strategic repositioning. These investments typically target a annual net return of 8 to 12%, offering meaningful upside compared to core strategies. As existing value-add funds mature and return capital, new commitments are essential to maintain target exposure and vintage year diversification. This ensures the portfolio remains aligned with board-approved allocation and long-term objectives. Our first manager to come in today is Blue Owl. This will be Blue Owl Real Estate Fund 7. This fund may sound familiar, or this fund manager may sound familiar, as they also manage a portion of our private credit portfolio. This is a net lease strategy, working with some of the largest retailers in the world. And I'll let them describe a little bit more as to exactly what net lease is, but you probably walk into a net lease business every single day. Everything from Walgreens to CVS to McDonald's to you name it. A lot of these companies don't actually own their assets. Well, they own the building, but they don't own the property. And that's what Blue Owl in this strategy does. This targets recession-resistant net lease properties with investment-grade tenants. Again, Walgreens, all the big ones. Aiming for an 8% preferred annual return. Blue Owl has delivered strong historical performance across prior funds, and their track record for this series is very impressive. Crow Holdings, this is Fund 11 for them. This is a diversified value-add fund. It focuses on diversified niche properties. such as gas and convenience, manufactured housing, self-storage, but also has or multifamily and industrial. And they have a target IRR of 12%. Crow Holdings boasts 75 years of experience and a strong track record of navigating multiple market cycles. Very impressive firm. In line with the most recent pacing study done for PERS in Mississippi real estate allocation, the recommendation of a $75 million investment to each of the two proposed funds will allow the portfolio to stay in line with the value add target. Based on the tenure, stability, their success in managing unique real estate properties portfolios, staff recommends a $75 million commitment to be approved to each Blue Owl Fund 7 and Crow Holdings Fund 11. And I'll bring in, if there are no questions, I'll bring in Blue Owl first.
Did you say 75 million per company or total?
Yes, sir. That's our pacing is 75 per. Yes, sir.
Okay. That would be good. And how much time did you all allocate for them?
15 minutes for presentation with 5 minutes questions.
Very good. We're good to go.
And before we go get them, I'd like to say thank you to Mr. Clark and Mr. Busby on their speed and getting this search turned around to have these two managers in front of us today. So thank you.
Excited to share a different part of our business with you, namely the Real Estate Fund 7, which is part of our Real Assets platform. So just to quickly introduce my colleague, Gary Rozier. He's a senior member of the investment team for our net lease real estate investment strategy. He's been with the firm for a number of years. He sits on the investment committee, and there's really no better person to give you an understanding of really the investment process, how we go through buying pieces of real estate, what the transactions actually look like, but also anything else, asset management. I like to call Gary a little bit of a Swiss Army knife. He probably knows more about that business than anyone else on the planet. So really excited to bring him to Jackson for this conversation. Maybe I'll just take 1 minute and situate our real estate business within the Blue Owl platform. I think Blue Owl, for better or for worse, is typically known by most people as a private credit firm. And so the real assets business is actually our best kept secret, but it's really not small. So it's a $75 billion platform, and the net lease team has invested over $44 billion since 2009. So it's a 15-year track record, consistent outperformance of our target return after fees for investors. And it's a business that we're really, really proud of and excited to share with potential new investors like Mississippi PERS. I mentioned the track record. I'm going to turn the floor to Gary to give you a sense of what it is that we do, how we do it, why we do it that way. And then we're really thrilled to answer any questions that you might have. So, Gary, I'll turn the floor to you.
Yeah, thanks, Brad. And Mr. Chairman, staff, board, appreciate the opportunity to come to Jackson and present our net lease strategy to you. As Brett mentioned, I've been at the firm for a number of years. I come from our legacy business, which was called Oak Street Real Estate Capital, which was acquired by Blue Owl about 4 years ago. And we founded that business in 2009, and I always give that time frame because we were on the heels of GFC when we designed our investment process, and the idea was structure a real estate investment strategy that would have weathered that storm while paying our LP-based cash every single month. And our investment criteria is structured around that premise, and I'll walk you through that in great detail. But always start the conversation by just walking through what net lease is. Net lease is not necessarily a new real estate asset class, but it's new to a lot of investors. Most think of real estate in terms of what I call gross lease, where the owner of the asset is responsible for operating the building as well as paying all the operating expenses. Net lease is quite the opposite. So usually when we acquire our assets, typically that's off of the balance sheet of corporations, and they're investment grade corporations for that matter. We lease the asset right back to that tenant, but structure the lease or our agreement in a way where they're responsible for operating the asset and paying all the operating expenses. So if you think about real estate, like many investments, you've got your cash flow, you've got your expenses, taxes, maintenance, insurance, capital expenditures, utilities. Well, within net lease, our tenant is responsible for all of those expenses. They have to pay us our cash flow net of all expenses. That's why it's called net lease. Well, I think that's the greatest structure within real estate because we've effectively just mitigated the expense side of the equation for you. And those are usually the things that give investors the most angst about real estate. It's only as good as the ability of the tenant to actually do it. So we've driven a hard stake in the ground since we launched the business that we will only transact with investment grade or credit worthy entities, right? And most of those companies that are inside our buildings are global, national, publicly traded, very large corporations that you would know by name. So organizations like Oracle, Intel, 7-Eleven, BP, Schlumberger, these are companies you expect to be around. You expect to weather market cycles, pay the expenses per that lease, and then pay us our cash flow afterwards. So just those two things there are in our DNA. What I always say is just by structuring your leases to be net lease, working with IG tenants, you have mitigated much of the real estate risk you typically see within gross lease. Every single deal we've done since we launched the business has those two things incorporated. So as we continue to exhibit the strategy, just know we're always going to structure our lease where you have no exposure to expenses. And at time of acquisition, our counterparties will be investment grade rated corporations. In terms of the size of that world itself, usually I get the question, well, what's that addressable market? We think about it two different ways. One is just pure transaction volume. That's probably the easiest way to think about it. So if you take the peak of net lease transaction volume, that was in 2021, it's $110 billion. So it's pretty big. So even though you may not have heard the word, there's a lot of transaction volume there. We think of it a little bit different though inside Blue Owl Real Assets because most of what we're buying, like I said, is not in the brokered market. It's directly from the company themselves. So our question is, well, how much real estate's on the balance sheet of IG companies in North America, which is where we focus, right? That number is $15 trillion. Right, so if you take transaction volume, even at a peak at 110 billion with a B versus what's available 15 with a T, it's less than 1% transaction volume. So we think of our total addressable market as so big that I can't really quantify it for you, which we think is a great thing. Within net lease, we have an 80% market share. Right, so of every dollar that was ever been raised in net lease, 80 cents of that has come from our shop. I tell you not to be boastful, but just to understand this is the only thing that we do within real estate, the only thing we've done for 15, 16 years. We're not all things, all people. We're net lease, investment grade. That's where we focus. So it's an asset class that we know extremely well. In terms of what we do, right, what I call our rules of engagements, the way that we have to invest, this has not changed since from Fund 1 until this very day. Number one, all single tenant assets, nothing special there. It just means we have one tenant in all of our assets. We will build a diversified portfolio across asset classes. But what tends to be the areas that we like the most because they tend to have the most mission critical assets are areas like industrial, that could be warehouse, manufacturing. I'm a Pittsburgh boy, I love manufacturing. That could be, again, warehouse or logistics. Within the industrial sector, we think that is mission critical, again, because you need that asset to operate where you generate your revenue. So the likelihood you pay us rent is pretty high. Beyond that, we will invest in retail, but we invest in what I call the essential of the essential. So think of grocery stores, pharmacies, discount retailers, gas and convenience. Right, these are areas of retail that we don't think about. We need them every single day. So even through tough parts of market cycles, you still will go to those types of businesses, which means they probably will generate cash and again can pay us our rent. Beyond that, you'll have areas like data center. Data center has grown, and we could talk about AI all day. Our perspective is we like the asset class not because we're smarter than anybody else when it comes to AI and the future of AI. What I know is the need for capital in that space today is larger than anything I've ever seen before. And those hyperscalers, again, companies like Meta, Google, Microsoft, great credit businesses, they need the capital because they don't want to spend it on the building. It's not where they generate the revenue. They want to spend it on all the things that go inside, right? So they will come to us to be able to provide capital for the construction of that data center, and we'll just own the shell. So we're not even taking risk on the obsolescence factor of what's inside the building. They have to pay us regardless. So we like the sector for that reason. We're actually looking at a couple assets over here in Meridian within a data center space. We believe in long duration leases, right? So 15 years is usually what we target. Why long duration leases? Well, if somebody's going to occupy my building and have to pay rent and the expenses contractually, and well, naturally, I want that as long as possible. So it almost functions like a bond or almost like a credit strategy from that perspective, because it's really about just cash flow for a long period of time. So we structure those leases to be long duration. Today, we're actually trending even higher. So our portfolios are more like 16, 17 years. Now, anything long duration, you want to make sure your income stays competitive over time. So we build in rent escalations as well. So we target 2% per year. That 2% number usually does not jump off the page as being very large, but remember, I don't pay expenses. So that means that 2% goes right to my bottom line. So it's really net operating income growth. So not only do I have this long duration cash flow stream, it's growing every year by 2%. Right? That's pretty powerful over the course of 16, 17 years. Most important thing we do, which is the hardest, we set a minimum cap rate, or said differently in layman's terms, a maximum price that we'll pay for an asset. It's 7%. That's really hard to achieve, number one, because usually IG tenants don't sell you their real estate at that level of a price, right? But we're getting a really, really strong unlevered yield of at least a 7% yield. And again, that's a hard rule. So I can love an asset with a great tenant. If it trades at a 6.5 cap, it can't do it, right? And that's kept us out of trouble over the years because, again, we don't chase pricing, right? So over the last several years where you've seen a reset in real estate, we haven't had to mark down assets because we didn't pay that much for them, right? Again, said differently, we're buying $1 million buildings effectively at $800,000, usually buying at about a 20% discount. Now, we do all that. That's a pretty stringent investment criteria, self-imposed. So if you look at our LPA, you're going to see all that laid out, right? And we can't operate outside of it. We do that because what we want to do is structure a yield that is consistent and everybody can see exactly what it is over time and it doesn't change. So this fund pays an 8% annualized yield, but we pay that monthly. Reason why we pay monthly is because the vast majority of our client base are LPs just like you, public institutions that have pensioners that rely on that money, so we pay it every single month. So you're getting cash flow every single month. And over our history, 192 months, we've never not one time missed a monthly payment. That includes the COVID months, right? So that cash flow we think is extremely important. Now, how we do it, everyone always says, well, okay, well, great. I know what you do, but like, why? Why do you choose those things? Well, why triple net? Well, I don't have exposure to expenses. That's a good thing, right? Why investment grade? Well, the risk of default in an investment grade rated company is far less than a non-investment grade rated companies. And we've worked with over 500 tenants. We've had 5 defaults ever, right? So that's less than 100 basis points of default, right? So it just doesn't happen. Even when we've had defaults, we've never actually taken a loss, right? Because we own mission critical assets that we can either sell or re-tenant. So even when the situation where you had a default, we've actually never even lost money that way. Why long duration? As I mentioned before, it just gives us more optionality. Let me give you a strong example. We just lived through a pretty tough real estate environment the last 4 or 5 years. We were never worried because we have leases that are 15 years. Right? If I had 2 or 3 year leases, well, you've got to get lucky in that period of time. Things have to go your way. 15-year leases, I never have to worry about it. I have a long period of time to figure out how, when, and if we dispose of an asset. Right? So long duration leases helps us a lot as well. In terms of sourcing, I think this is the most non-real estate thing I can tell you, coming from a real estate guy, so follow me on this. We think of approaching our transactions less about focusing on the hard asset, more about being a corporate finance partner to these investment grade rated companies. Philosophically, our point of view is if you have a great operating business, it's not real estate. Take Starbucks, for example, their job is to sell coffee. Or my hometown company, McDonald's, they should be selling hamburgers and french fries, right? That's where they generate their revenue. Owning real estate really just ties up your capital in an asset that is non-earning. Right? I don't think that makes a whole lot of sense as an investor. So we're approaching these companies and saying, well, we can be a great financial partner to you by monetizing that real estate, so you can then use the value today to put back in your great operating business. That's a much higher use of your capital than to have it tied up in this business. So we spend our days not necessarily talking to brokers about what's for sale. We spend our days approaching CFOs, treasurers, board members. My job, I know a lot of board members in the country that I can speak to about this solution, and we're saying we want you to think of us as a corporate finance partner. So when you have a need for capital, and there's many of reasons why they might have a need for capital, it could be they're executing on a merger or acquisition. Well, we can monetize the real estate. You can take the proceeds to pay for that acquisition, right? You're a manufacturing company. They tend to carry a lot of debt. Well, at some point, you have to pay off that debt. Well, we can monetize your real estate to let you pay down that debt. During COVID, we were the second most active buyer of real estate in North America behind Blackstone, with 25 people on our team, by the way, because we were going to companies saying, we understand that you don't know exactly what your future is going to look like, and you probably have a need for increased liquidity. Well, we can monetize your real estate in the next 30 to 60 days and put more cash on your balance sheet. Right, and that paid off for us beautifully over time. But again, that's the way we source transactions. Why I tell you this, it's the fun part of my job, of course, why it's important to our investors. If companies see us as a corporate finance partner, they're far more likely to give us a better price on that asset than if I was just buying it in the broker market, auction with everybody else, right? So again, if you see over time, we've historically paid, as I mentioned, about 20% less for our assets. I like that number because it does two things. Number one, it gives us a lower basis or more downside protection. Again, remember, you bought $1 million building for $800,000. If that value goes down to $900,000, I'm not underwater yet. But the other thing is we've historically bought at that 800 number and sold at that $1 million market price, right? So what you've seen over our performance over time, and I'll end my prepared comments here, is I mentioned having paid our yield. That's job number one for us, making sure that that comes back in your system so you can pay your bills. That's number one. We've never missed a monthly payment. Number two, if you looked at all the funds that we have fully realized, so Fund 1, Fund 2, Fund 3 fully realized, weighted average net return of a 24% IRR. Again, it's because we're buying at a discount off the balance sheet of these companies, selling back to the broker market, just at a market price, right? And that's really the goal. So in summary, what I think we provide and what I hope you've seen is, number one, a lot of downside protection that is structural in our investment criteria, structural. Second thing is cash flow, right? So we're paying you every single month. We understand that you guys have bills to pay. You have pensioners that are very much dependent on what you do and the decisions you make. That cash flow helps ease that. Lastly, we sacrifice no upside. And again, we've been able to showcase that we can also deliver returns in excess of our target. So we really want to hit on all three of those things, and we've done that over the course of, again, our previous vintages. So I'll pause my prepared comments there. Brent and I are happy to answer any questions you might have.
Board members? Questions? Staff? Yes, go ahead, Judge.
Gary, you said that it's very defensive in looking at the geographic regions. Is there any geographic region you see as better opportunities, or on the other side, or worsening opportunities in which you're looking at these opportunities?
Yeah, anytime you deal with real estate, I mean, geography matters. I mean, there's no doubt about that. But what I always say, and within net lease, it's a secondary consideration. Your first consideration is always the credit quality of the tenant that you have in the building, because that's where your cash flow is coming from. Beyond that, you want to make sure that the asset you own is highly mission critical, right? Because that lowers the risk that they'll leave it, higher the likelihood they pay you first. Then you want to think about geography, but geography really is kind of on the back end, right? So when you go to monetize an asset, geography matters. To answer your question specifically, I love answering this question here in Mississippi. If you looked at all of the assets that we've ever owned, we're in every single state except for Hawaii. I've still been looking for that asset so I can go see it, can't find it. But most of our assets will be between Texas and Florida, southern half of the U.S. So we tend to have an overweight to this area of the country. But again, it's not by design when we're coming in from the top saying we want to own assets more so in the southern part of the U.S. It just so happens that that's where they are. But I could make a strong argument when you go to monetize assets, that's been the region that you've been able to get the highest return. So I'm happy that we're overweight to the southern part of the U.S.
Specifically, anything in Mississippi?
As I mentioned before, I'm looking at some data centers in Meridian, and if I butcher this name, I'm so sorry, and so sorry to Elvis. Is it Tupelo? Tupelo. Looking at a very large industrial asset in Tupelo as well. That one is likely to close for us.
And I'm from Tupelo. Three of us here are from Tupelo.
Did I say it right?
Yes.
All right, all right.
But I have seen that with our industrial folks. They don't own the buildings. There are very few of them, the newer folks who come in who want to own the building.
Yeah, I mean, again, it makes all the sense in the world. You could thank, it was really three companies that really kind of brought that to life. When I started my career, trying to get a company to part from the real estate was extremely hard. You know, but Amazon, Starbucks, and McDonald's, again, three very prestigious companies came out years ago and just said, you know what, it doesn't make sense for us to own real estate. A lot of other companies followed suit. So what you're saying in your hometown, I think, is really kind of reflective of what we're seeing across the country. And it makes my job a lot easier because, like I said, in the early days, it was so hard to try to convince a company to part from the real estate because we always had the mindset that you should just own it. And that comes from us as individuals. Usually our home is our most valuable asset. So, of course, you wouldn't want to sell your home, but a business, your most valuable asset, your operating business, right, not the real estate. So it's great to see regions like that coming up. And I actually think Tupelo is probably going to be one of the nice growing areas from the industrial perspective in the future. So hopefully this isn't the only asset we buy.
Question, since my friends over here, but Tupelo gets all the good things and us at Clinton hadn't got anything. Has there been enough on these data centers, enough research on the effect of the electric grid and the water table? Has that been overlooked, and does that be a problem down the road?
Yeah, so bifurcated between those two. So the linchpin within data center growth is energy and power and how fast you can get it there and how much of it's going to take. So for us, when we choose our sites, we want to make sure that power is there or can be delivered in a short amount of time. You have areas like Northern Virginia, which is probably the largest data center area in the United States today. There's going to be a power problem there. Like there's not enough power. So power is actually a big linchpin. It's a big issue. So if you look at our data center builds, they are in markets like Abilene, Texas, El Paso, Texas, Richland Parish, Louisiana, looking at Meridian, places that, again, I know we can deliver power where it's not going to be an issue for that particular area. Water, on the other hand, I think has been oversold. And I'll give you an example of this very quickly in the interest of time. We're developing a data center in my wife's hometown, Amish country, Pennsylvania, called Lancaster. And we had to sort of deal with the local communities there. They were concerned about water usage there. And there's 3 very large golf courses within 2 miles of that data center. Our data center is going to use 1/6 of one golf course in terms of water usage. So I actually think that's far less of an issue that's been reported. But I do think power is a very large issue, right? The cost of it, the delivery of it, the time that it takes, that's the biggest linchpin. So when we're looking at our sites, we actually think about power in a way that we just want to make sure it can be delivered in a short amount of time, and it's not going to be a pull on that particular region, which is why we like tertiary markets.
They have to plug into TVA. We don't have TVA in Clinton.
Got a nuclear power plant, Clint.
Nuclear power plant's good. That's what you want with a data center.
That's not a coincidence as to why these data centers are right here in Jackson. I don't think.
That's right. No, that's a good thing. Nuclear power will be very important in the growth of data center in the future. Matter of fact, we are funding development of a number of substations for our tenants as part of our build. This way they have captive power on the property right there. But it's also good for that region as well because you're bringing in more power capacity.
Yeah, and that's an interesting point I would just add is that similar to the water point, if you just look at the parts of our country where they've already had a lot of data center build out, those actually aren't the areas where they've seen electricity costs rise for consumers. So Northern Virginia, for example, sort of undisputed data center capital of the United States. Electricity costs have risen there at a much lower rate than, unfortunately, my home state of California or other places like that where there are no data centers. So it's not quite as a simple linear story as data center gets built. That means that local electricity costs go up for everyone.
In fact, the opposite is happening because, like you say, Brent, there's a commercial I see now, saw it last night 4 or 5 times, where Mississippi's brought Amazon here. And that's going to lower the utility bills of these consumers by $2 billion over some period of time.
Right. I believe that wholeheartedly. I always sort of pause before I say that because it's outside of the realm of my compliance department and get very mad at me, but that's a fact. When you bring in a Meta, you bring in a Microsoft or a Google, your tax revenue is a great benefit, to that particular area over time. And if you do it the right way, like I said, it's not a pull on your resources. You'll actually have more resources. So more resources, higher tax base. I think that's a good thing for those local municipalities.
Other questions? I will say this, I appreciate your presentation today. I want you to know that your company is impacting the culture of the South in I don't know if it's a good way or a bad way. We used to give directions by go down to the Coca-Cola bottling plant and turn right. Now it's go to the Dollar General store, but pass that one and it's the next one you turn right. So Dollar Generals are in our direction giving nowadays. So we appreciate y'all coming today.
Thank you so much.
Thank you. We appreciate it.
Thank you.
Have a good rest of your day.
Is that people they building down there a lot of bit Beasley pasture or Hancock's pasture? Is that?
For I don't know how long. That one hasn't been built yet. No, it is. Digging that hole.
Stage 2.
That's the reason they tell us.
Ray, their home office is in New York City. I wonder where he flew in from.
Probably there, but I'm not sure, yeah.
I wonder how he got out.
Well, that's true with the, yeah, good point.
How long do y'all want for lunch today? How long do you want for your lunch today?
Chicago.
It's gonna be 12:25, 12:20 or 12:25 before we get through this.
Go to 1 o'clock.
About 1 o'clock still, aim for. We're glad you all are here today. We're gonna turn it over to you. I think you've already talked about the amount of time we have available, so turn it over to you all, and, looking forward to hearing what you have to say.
Okay, thank you.
Perfect, thank you. You can hear us okay? In 15 minutes, around that time? Okay. Well, thank you all for having us today. Since everybody has a copy of the presentation?
Yeah.
Everyone's good? Awesome. We're Crow Holdings. Thank you for having us. Since this is in contemplation of a new partnership, I thought I'd maybe just spend 30 seconds on the firm. So if you guys can flip to page 3, Crow Holdings is a real estate investment management and development firm that has a 75-year history. We run a book of about $34 billion of assets. We are real estate only. That is all we do. We've got about 600 people across 20 offices across the U.S. We are here today talking about our diversified value-add flagship real estate strategy. We have about 30 years of experience executing on that strategy. And I'll just point out a couple things why our partners seem to love us and kind of what we're known for in that real estate strategy is first, we got out of office early. We haven't invested in an office asset in over 10 years. And second, we get our investors access to some harder to access niche asset classes. I'm sitting here with Rodney Whitley. Rodney leads our specialty sectors at Kroll Holdings. He sits on our investment committee. He's been in the industry for about 33 years and with Kroll Holdings for 29. He's a recovering CPA, so please forgive him. And Rodney leads our specialty sectors in manufactured housing, in convenience and gas, self-storage, and retail. So we'll talk a little bit more about those later. I'm Susie Bailey. I've been with the firm for about 18 years. I've done a variety of different things, but I'm very fortunate to work with our investment partners in the Midwest and the Southwest and the Southeast today. And so if there's anything that you all need at any time from Kroll Holdings, think of us as an extension of your team. We would love to be helpful in any way we can. So with that, maybe I'll turn over to track record. Of course, we have a 30-year or 28-year history of executing the strategy that we're talking about today. We have executed over 512 realized transactions, delivering a 23% gross return and a 1.7 times gross multiple. We have 7 fully realized funds in that top table. We have 3 active funds. Of the active funds, Fund 8 at the top, only 1 deal left, so those returns are locked in at a 28 and a 1.9. Fund 9, we're very pleased. That's a 2020 vintage fund across real estate cycles. It's a more challenged vintage. We've already realized about 30% of the equity today and given investors back 43% of their capital. So those are market leading stats there, and our investors are very pleased that we've been able to give back a lot of the money that they invested in that difficult vintage. Fund 10 is nearly 80 to 90% placed at this point, which brings us to the conversation about Fund 11. So we are very excited to be launching Fund 11, looking forward to a first close here in the next 30 to 60 days. So that track record is certainly the result of a very experienced team. If you can flip to page 5, you can see our 13-member investment committee. Rodney's beautiful face is in the bottom left-hand corner. On average, we have a 29-year experience on our investment committee and over 23 years working together. And so we have great tenure on our investment committee, great experience. We are supported by a 94-member team, large team sitting in Dallas. That's important because you'll hear Rodney talk about those niche asset classes that we pursue, have smaller equity checks. So we do a lot of them and we like to aggregate. So you need a big team to be able to process all that volume. If you flip to the next page, page 6, alignment with the firm and with the family is a real hallmark of our investment style. We are a privately owned firm. We intend to continue to be a privately owned firm in perpetuity. Of the nearly $16 billion of capital that we have raised over the past 28 years, 1.5 of that has been committed by the family and the firm. They're going to, or we are going to be committing $100 million to Fund 11. And that's not a line of credit. It's not a loan from anybody. Those are checks and capital calls that we are issuing ourselves. So we are equally as excited about the opportunity of coming in Fund 11 as you all are. So with that, maybe I'll hand it over to Rodney and you can take it away with strategy.
Okay. Well, first of all, thank you guys for the time today. I'm going to talk to you first about the markets that we are targeting and why we are targeting them. If you turn to page 7 on your package, you'll note that there's about 20 markets that we're interested in investing. Those are not exclusive, but they contain the characteristics that we look for in any market. They're typically diversified economies, and what we've found in terms of debt options in those economies is that we have more choices. In those primary markets, there's more competition, and with competition gets a better deal for us. And then, as you guys know, we're a closed-end fund, so we will be exiting these assets at a certain point in time. And in these markets, we typically see a lot more buyers than you do in the tertiary or secondary markets. Now, one of the things I like to bring up also in these markets that we look for is choices in service providers for leasing and management. We're not vertically integrated, and that's by design. We like to get multiple opinions about a market or a particular investment, and by tapping the knowledge of multiple firms as they're competing for our business, we feel that better positions us to be a good partner to you guys. The last thing is that we're not vertically integrated because we like choices, and just in case our strategy is not being executed to our liking, and we have the ability to switch those service providers because all of our contracts are 30-day cancelable. So the next page, let's talk about what we like to buy. And they're basically highlighted in gray there, as you see there. These assets to date have generated a 27% IRR and a 1.7 multiple. Why do we think that is? Well, because there's resilient tenant demand, both currently and future, for these assets. What we like about them, even though the type of building, at least visually, will change, they typically will have the same characteristics that we look for, and that, in summary, that is low tenant acquisition costs, meaning it doesn't cost a lot to get a tenant, low CapEx requirements, opportunities to mark rents to market. One of the things also, because of a large team, especially in the specialty sectors, is that you're able to aggregate smaller deals that appeal to a larger market that doesn't necessarily want to trouble with smaller check sizes. We're able to aggregate those and meet the needs of somebody seeking scale upon exit. All of our strategies and all the opportunities we look for is the ability to maintain stable and growing cash flows, and we think that will appeal to the market once we go to sell. You may see that we do not do office and do not do hotels, and I'd just like to expand on that for a second. For office, it's basically a capital imbalance. It costs too much to get a tenant in place relative to the rent that they're paying today. Office has got a lot of issues, but we've thought since the last 3 funds that it's too expensive to re-tenant it, and so we are not going to be pursuing office in Fund 11. For hotel, over our investments, what we realized is really not a real estate location play. People book hotels based on the reservation system and the flag on the hotel and not necessarily the location. So it's less of a real estate play and more of an operational play. So we're also not going to be investing in hotel for that reason. You go to page 9. Let's talk about the philosophy here. And we've got a large team of employees that are executing this strategy, and that allows us to do multiple deals. Multiple deals on average, 85 since Fund 3. What do those multiple deals do? Well, they insulate the particular individual investments. We like to insulate them from microeconomic events, from down cycle real estate events specific to that sector, and obviously from natural disasters. So that's the first thing that multiple deals gives us, it's insulation. On the offensive side, you get aggregation. This team can buy multiple small deals, aggregate them, and then when the market is right, exit on a portfolio level. If you look at this slide here, it's an example of just that very fact. During the pandemic, we built 13 industrial buildings. And while we could have exited these investments individually, at that point in time, there was a premium for portfolios. And so we chose to exit on a portfolio basis and actually outperformed what they would have garnered in the market if they were sold individually. So that's the advantage there. So we plan on continuing this strategy for those reasons in the future. Now let's talk about debt. Well, in short, debt is balanced and conservative. We have a cap on our on the debt that we will incur to about 65% at the fund level. We try to match the debt according to our business plan for the particular asset, so it's balanced in that way. In addition, as the life of the asset is realized, we established adequate reserves that's going to allow us to function in down markets and meet capital needs to maintain our occupancy. So from a debt perspective, that's how we silo the assets. The other thing that I'll note is that we do not cross-collateralize our assets either. And that's also an insulation protection for your equity. Now, I'd like to talk about one of the things I love to talk about because I lived them 29 years here. The first is when we're investing, we do track our primary targets, but we also don't have blinders on. We're looking at events or trends that may present an opportunity in a specific sector. And the first one I'd like to talk about, it happened in Fund 2. I was there. We chose to put 44% of Fund 2's capital in grocery-anchored retail. Why did we do that? Well, at the time, what we see today in e-commerce affecting online sales, that was thought to occur back in 2000. We believed that the technology was there, but we didn't think it was mature enough to actually affect bricks and mortar. The institutional ownership of the grocery-anchored centers that we purchased felt the other way. They felt like that was a true threat, and so they sold out of those grocery-anchored shopping centers in major markets like Washington, D.C., New York, and Chicago. We purchased those assets at a 9.5 yield. Debt cost was 5. We were realizing double-digit yields on those assets in grocery-anchored retail in those major markets. In 2.5 years, that market came back. Everybody realized the e-commerce had not matured yet, and as a result paid us a compressed cap rate, and we achieved a 40 IRR and 2x multiple. Now, as you see there, we did not allocate a lot to 5% to industrial. Well, again, following these trends, e-commerce actually did mature. And in 2008 and 2009, we started developing industrial. Why development? The e-commerce users of real estate needed new prototype, higher clear heights, wider columns to function as their business. And so we chose to build those. We put 30%, a little bit more than 30% in Fund 2 or Fund 8 and Fund 9, and realized a 60% IRR on those investments. So those returns speak for themselves. Lastly, I want to talk about convenience and gas. Now, this is something that I started back in 2009. So what started it? Well, 2009, everybody recalls, was the GFC. There was no capital anywhere. ExxonMobil decided, we're going to sell into that market. We're going to sell into the headwinds of no capital. And what we saw was real estate locations that drive profitability were available from ExxonMobil in Washington, D.C., Chicago, and New York for $1.6 million a site. It was a bit of a head scratcher for us, but we took advantage of it. And we bought over 300 sites at those numbers, relying on the real estate location, and actually realized double our money in less than 4 years. Okay, so that's catching lightning in a bottle, if you want to call it that. But one of the things we learned was the real estate really makes a difference with regard to that use. And so we continued that strategy on, and to date, we've purchased more than 860 sites nationwide. Now, we've realized about 650 of those generating comparable returns. And so we like that strategy, but it's important to note, we're real estate focused, not credit focused, because we're looking at the performance of the real estate. And again, after I think I have visited, I told Jason this, I think I've visited over 1,500 sites. And when you visit that number of sites, you realize what's actually driving performance. Now, the market today, it's still fragmented. There's about 150,000 sites nationwide. 62% is single owner. Single owner is a misnomer. It's usually people that own 10 to 20 sites. For the past 3 years, there's been a bid-ask spread because of interest rates. The tax law change in July of last year changed all of that, mainly bonus depreciation. That's creating development and, more importantly, acquisition opportunities. So the bid-ask spread is now narrowing, and we're actually tracking over $1 billion worth of activity today in that space. So with that, I'll turn it over to Susie to talk about sector allocation or strategic.
Yeah, so we're a real, real bottoms-up, very granular, visiting 1,500 sites type of real estate value uncovering shop. But it's important to do that knowing that you're not facing big macro headwinds. And so it's right now the time is great because we think we actually have some long-term secular trends that are supporting us. So for us, we kind of think about three of them, and then the fourth I'm going to let Ronnie chime in on. But U.S. domestic migration, there's no doubt that states with no income tax are attracting a lot of moves. Florida and Texas in particular, very attractive. If you look at the one-way U-Haul data, 21 of the 25 top locations are located in the Sun Belt. And so there's definitely migration to the Sun Belt. You heard us talk about our markets earlier. We're headquartered in Dallas, Texas. Our track record has been driven by a lot of Sun Belt investing. We're going to continue that. It's going to continue to be strong, even with the slight slip back that we've seen here recently. We're long-term believers in those markets. Second, demographics with the millennials and the Gen Z is at like 71 and 74 billion or million of population moving into their renter years. That's a huge amount of apartment demand. In addition, the average first-time home buyer age has gone from 30 years old to 40 years old in the past approximate 5 years. So not only are there more renters, they're renting for longer. So that's really going to support our apartment thesis as well. And Ronnie touched on it, but evolving supply chains, over 65% of all the leasing that's occurring in the industrial space is occurring in 13% of the stock. And that 13% of the stock was delivered in 2020 or newer. So the new buildings are absorbing all of the leasing activity. And we're really focused on industrial development and delivering the new types of building that tenants are demanding. You went over the track record, which does speak for itself in the industrial space. And then finally, the institutionalization of real estate. We're really seeing these niche asset classes benefit from more institutional involvement. And you're seeing it heavily in manufactured housing.
Absolutely. Susie talked about having to be 40 years old to be able to buy a traditional home. That's the reason why we think the affordability crisis can be met in some part by the manufactured housing community. Now, just to give you some stats, there's 40,000 sites nationwide, about 4 million homes. The occupancy averages around 96%. You've seen 20-year, year-over-year rent growth. and you have zero supply coming online. So if I said that about any other product line, you go, how much can I get of that? And that's the reason why we're interested in it. We've purchased to date more than 130 parks today. The industry remains fragmented. 80% of the ownership is mom and pop. And the ownership, the historical ownership has been passive. Guys getting mailbox money, what I call mailbox money, and really not putting a lot of capital back into these parks. And the way I phrased it is, they've actually, by their neglect, they have turned these into what we call manufactured housing. They've turned them into a trailer park. Okay, so our idea is to go in and provide the capital that's needed to not only meet the deferred maintenance that they have not been doing, but also add amenities like a swimming pool, a clubhouse, really amenitize the parks, and take that trailer park, if you want to call it that, back into a manufactured housing community. So that is our goal. We're gonna pursue markets where there's a disconnect, about a 50% disconnect between the cost of traditional homes and the occupancy cost and the cost of manufactured housing homes. And so we're going to target that, and then we're going to apply this, deploy this capital improvement plan. And then the other way of institutionalizing this, again, these are passive ownership, mom and pop. And so the accounting systems, being an ex-accountant or a recovering accountant, are less than stellar. So we're going to improve those systems and be able to tell the market how we've improved it, and then ultimately exit the space. Now, one of the things I want to hit on is when we're doing all this capital improvement, certainly we're looking at the difference between market rents and current rents. So we will be raising rents, but we're going to do it very cautiously. Primarily, most of our rent growth is coming from new tenants coming in. You have to be very cautious in this market when you're looking at existing tenants. The capital you're spending is going to translate to equity in their home, but you can't go in and just arbitrarily raise their rates too much. So we're very cognizant of that, and we're going to be mindful of that in the future. But we like the space, and I think our allocation is 20%, and I think we'll meet that goal in Fund 11. Back to you, Susie.
So the final page here is, these are the product types that we intend to invest in Fund 11. Like Rodney said, we're excited about manufactured housing, targeting about a 20% allocation there. If you go from left to right, industrial, we're targeting about 30%. Manufactured housing and apartment, 20 each. Retail and convenience and gas, about 10 each. And then student housing and self-storage, about 5 each. And so we think that 2026, 2027, 2028 should be really nice vintage years where the markets are pretty balanced. Folks like us that have a bottoms-up approach should be able to tactically take advantage of some really nice opportunities across these product types in the coming years. So we're excited to be marching towards that first close of Fund 11 here in 30 to 60 days. And we're targeting about $3 billion for that fund. We've sized it right next to the previous fund, so really no change in huge swings in teams and allocations there. And we're looking at about $1 billion first close. So really nice momentum from some, potential new folks like you all and some, recurring partners that have been with us for a long time. So that's what we prepared to talk about as regards to the slides, but we're happy to answer any questions that any of you may have.
Mr. Chairman, one quick question. In another life, I regulated the Mississippi manufactured housing industry, and at that particular time, they were going into the doldrum. Are you saying that they're coming out of that now?
I think they are. I think most of the housing stock that you see are certainly a lot of what we see. You'll see new housing coming in, but for the most part, they're 30 to 40 years old in terms of the actual structure. But keep in mind, our approach is we're not going to own the home. The tenant is going to own the home. We're just owning the land. And so we're going to improve the infrastructure to the land, the streets, the plumbing. I mean, there's so many things that you can do to these. So yeah, I think that area is a way that we can meet the affordable housing. If you look at the cost of getting an apartment, or certainly stick-built construction, traditional family, I mean, it's generally, in the markets we're looking at, it's half the cost. And if you look at the product that's being delivered, in terms of the actual structure and the living quarters, it's not dissimilar. And in fact, if you look at the apartments, you're getting more square footage than you're gonna get for the same amount of money. I don't know if I answered your question, does that?
It does, but some areas in Mississippi, our county commissioners like to keep them out of their area.
We discourage parks as much as we can in my area.
Understood. It's a low tax base, for sure. And I think that definitely needs to be addressed. I've got some ideas that go through my head as to how that would be addressed, but I would say that what we're doing to improve the area, I mean, again, we're going from a trailer park to a manufactured housing community. And you get a feel for it if you drive these things, and I've driven a bunch of them, and I was talking to Susie about it earlier. I said, you feel like this is a trailer park, or you feel like this is a community. We're trying to get to that community.
That's our problem, is most of them that we have are not.
Exactly.
Attract tornadoes.
They attract the sheriff's deputies a big portion of the time also.
Oh, no.
Well, and again, part of the improvement is also security. I mean, we're putting in lighting. You're trying to basically regenerate the interest in it. But I will grant you, it is a challenge, but that is due to the passivity and lack of attention over the years.
My vision is what I used to see in the 1950s and 60s, Florida manufactured communities and Southern California manufactured. That's what I envision you're trying to do.
If you look at Florida, we've got several deals in Florida. They've got 2-car garages. I mean, and porches and everything else. And there's a way that you can, it's called pit setting. You can pit set a manufactured home, and it looks like a home. I drove through one in Sheboygan, Wisconsin 2 weeks ago, and you're driving through, and you drive through a traditional neighborhood. It doesn't look dissimilar, especially when you don't have brick homes. So these are not brick homes, obviously, but where you go into these markets where there's not a lot of brick homes, that vinyl siding is basically a manufactured home.
Apparently, you can't see the wheels.
You can't, because it's pit set. It's pit set. It's pit set. Now, it's more expensive, but you can make it look really nice.
Other questions from board members, staff? Mr. Wiggins?
Nope, nothing more to add for this.
We appreciate you all coming and sharing with us today. Looking forward to maybe our future working together. One last question for us as you leave?
No, I don't have any, but
We appreciate your time.
we appreciate your time.
And your
Thank
Thank
you
you.
all so much. Have
Thank
a
you.
great day.
You too.
I don't have to have a special.
And approve them as our investment managers.
We have a motion. Do we have a second?
Second.
We have a motion and a second. Any further questions? All those in favor say aye. Aye. Those opposed? There being none, we have approved those two value-added real estate managers. Okay, what's next on our agenda?
Next on the agenda is previews for asset managers, but it's a good time to break for lunch.
Yes, we're gonna do that. There is one item that we had one member that had to leave, and I believe you may have to leave a little bit later, so.
That's right, about 2. So if we needed to move that up, I was going to ask Ray how formal that needed to be.
Sure, I think he's referring to the RFP draft, which appreciate you mentioning that. I don't think this necessarily has to be too formal in the committee. I'm gonna look toward the attorneys and see if they need an official, motion to rearrange the agenda for the committee meeting. I'm thinking maybe not. Any thoughts there?
Just do we need to have a quorum here before
Yeah,
we
just-
vote? And if he is gone, do we have one?
We need to check that, of course, but, and I think we still do. We do need to have a quorum. Let's see, 1, 2, 3, 4, 5. I think we do, yeah, let's see, 1. Commissioner Graham dropped off.
So we may need to vote before Kelly leaves us.
Well, if, we could certainly, I would, totally up to the committee, but, I can certainly say my part very quickly.
Well, we can wait till after lunch. I think it's just a question of whether the chairman can decide to bring that up in the wrong order of the agenda, if that matters.
Can I rearrange it just on my saying we're gonna take up the investment consultant RLP prior to the others? That's the question, just moving the order of the meeting. And since we are not changing, we're just recessing the meeting and coming back, and we're still gonna have everything, but we're gonna take a 30-minute break. So.
What we're saying is maybe just make the motion and everybody agree to it.
Okay.
I'm sitting there thinking the same
Do
thing.
I have a motion?
Yeah.
We got a
I make a
motion that
motion
we're
to
going
move
to
that.
move the investment consultant up. We have a second. We got a motion and a second.
Who was the second?
Second right here, Bill. Any further discussion? All those in favor? Aye?
Aye.
Aye. Those opposed? Okay, so when we come back, we're gonna spend time on the investment RFP first to try to make sure we got a quorum to vote coming out of subcommittee or the committee meeting, and then we'll take up but we're gonna take 30 minutes and come back at 1 o'clock, so y'all eat quickly so we can have time to do what we need to do there. Is it good?
Thank you, sir. Yes.
Okay. number 5, and we're going to address it right now, and then we'll resume with our mid and large cap manager presentations after that. So I'll turn it over to you, Charles.
Thank you, Mr. Chair.
Thank you, Charles and Mr. Chairman. At the proper time, would like to ask for the committee to vote to approve moving forward with a RFP for the investment consultant. But first, I want to take a moment to thank Charles and staff for putting all this together. Also want to emphasize that right now, the recommendation is not to make any changes, just simply the RFP. Certainly as it relates to Callan, I enjoy working with Callan. I certainly hope and expect that they will bid on it should this be approved. And I think it's important to remember, in addition to the staff, certainly, as well as the board, that Callan has been an important part of our success over the last few years. That said, though, as fiduciaries, though, we think it's good to go out for an RFP at this time. The primary reason just being, best practices, and then also, especially in consideration of the evolution of the portfolio over the years. And by that, I mean the addition of private asset classes and alternative investments and evolution of the market. And by that, I mean the fact that now there are firms that are specialty consulting firms or alternative investment consulting firms that may not have been there 10 or 15 years ago. So that's the primary reason as far as wanting to move forward with that now. Certainly, Charles and others can go through in more detail. Happy to answer any questions that you have. As you saw in your materials, we have 2 RFPs. One for general consulting, the other one for the alternatives. They're essentially the same except for that difference. And the reason they're done that way is to just make sure and not to exclude anybody. But we certainly could either have them separate or merged together. And as I begin to close with these few opening remarks, I'll say this is a little bit of a unique situation. We don't typically have as much information. If you've seen the materials, there's 2 draft RFPs as well as 2 summaries. We don't, at this stage, we typically don't have as much information. But in talking with Dr. McCoy as the investment committee chairman and realizing, of course, how important and unique and sometimes sensitive that the investment consulting and the investment function is, we thought this was best to come forward with this now. And then lastly, in the event that this is approved and we move forward to Commissioner Dale's point earlier, we do have a section on our website for RFPs, requests for proposals, which we would put this, and we certainly welcome any firm, and in particular, including those that are local firms, should they have the interest and capability to bid on that. So with that, appreciate the time. I'd be happy to turn it over to Charles for more detail or answer questions, or whichever the committee or Charles prefers.
I would like for Charles just to address the RFP, what was behind the staff, just give us a general set of information about this, about how it was put together, what it addresses now that the previous one did not address, just a little bit of everything, if you would.
Sure. First, I'd like to start off with is that the reason for the RFP is, over the last 10 years, the markets, we've seen a wholesale change in the markets, period, and how you access those markets. But what hadn't changed is the need to be good custodians of the assets. And part of that is knowing that we are getting the best. And I'm not saying that we don't have the best. I'm saying that we don't know that we have the best, that we have the best consulting available to us, just so we can show that we are doing our responsibility on that front. So when we went through the process of putting this together, we did rely heavily on the format that we've done in the past for consulting. But what we did do, Jason did do, is he reached out to a lot of our sister pension plans, and remind me how many it was exactly again?
12.
Yeah, 12 different, from all over the country. And in discussions with them, found out what their experiences were, what type of questions that they felt were important. And we, in addition to items that we felt were important to us as staff, Mr. Higgins, and for yourself as the board members, as the trustees, would better address whatever questions there are related to what are the strong points in consulting period across the board. Another thing that we did realize is that alternatives are a significant part of our portfolio now. And there are firms out there that all they do is consult on alternative investments. So we decided that it was probably best to have two separate RFPs. Firms can bid on for both or just one or the other. But by having two separate, it doesn't exclude those consultants that only do alternative consultants, and it doesn't exclude those consultants that only do general consulting. So if there's anything that I've missed on what you want me to, cover.
When was the last time we did an RFP for this position?
The last time that we did an RFP, I believe, was in 2017.
Okay, and as I read that, what are some of the items that in your own evaluation of what we're doing, and then what the other sister funds have done, what are the things that are different in this RFP than the one we did 9 years ago, 10 years ago?
I'll start and then I'll let you kind of, outside of having two separate RFPs, one RFP focusing directly on alternative.
Yeah, let's make the assumption that somebody's gonna do both of them.
Both of them.
Yeah.
We added quite a bit to systems. Things that were not really available 10 years ago. We want to see what type of new tools are available to make sure that we're getting the best research reporting available to us, very timely. And what would you?
Technology in general, technological advancements, portals, dashboards, the ability to sign in, look at portfolio in a single area. We've had this capability before through another program called Juniper Square that we did about 6-7 years ago. And we had the capabilities of going in and looking at the entire real estate. It was just real estate at the time. Our entire real estate dashboard, as granular as going down and looking at the assets on a map. That is something that is incredibly helpful when you have wildfires, earthquakes, hurricanes, to go in and be able to look at these assets, know where they are, know if they were affected, and just a better understanding of the portfolio assets in general. That's a small portion of the technology. Again, the other side of it would be just portfolio management from a portal standpoint, looking at capital calls and distributions. While we keep up with that, currently it's all done manually. It comes in, I write it down, or I have a spreadsheet. Having that done through a technological advance, it would be an advantage. And I know that Callan and some others are working on those type efficiencies. Again, to Charles's and Michigan's statements is that it's good to just see what's out there and how they're doing it and what they're doing. As far as the specialist goes, nowadays you see now that you don't see 10 years ago. These firms are focusing on their staff, on their research. They're bringing in analysts who can compile information through AI and other computer-generated information sources is amazing. Reporting the information, the research that they're able to glean from these data sources is something that it's hard to imagine. I've had a chance to look at them when I go meet with these managers, and do demos. It's amazing the amount of information that they have available that unless you have access to the technology is hard to replicate.
Probably the last time we did that before the 17 was probably about 8 or 9, because we had the group Mercer. We had Mercer when I came in 2008, and then they got out of the business, and we did the RFP, and that was probably 2009, 10.
I think it was around 2011.
Somewhere right when Callan first came, and then 6 or 7 years later did one, and then we've gone 9. I guess this is very similar to what we did with actuaries.
Similar.
And that periodically we've just felt it was in the best interest to re-advertise and look at it similar to what we did with actuaries.
Well,
that's right.
You know, from my perspective, I think that it is a fiduciary responsibility to make sure that we're getting the best advice available. And I think that it's a reasonable thing after 10 years to look at the market to see what is there. I think that one of the, let's see if I can get back. One of the things that since we're looking at, I just wanted to make sure that we don't have any organization that we have talked to help us put the RLP together will be bidding on this in any way, shape, form, or fashion to eliminate any sort of whatever you call it, conflict of interest.
I can assure you that this RFP was fully generated in-house. And the only thing that we did is we reached out to other pension systems across the country just to see if they would mind if we looked at their RFP, if they've done one recently, just to kind of give us an idea of what type of questions they've asked to see if it may be relevant for us. We have not reached out to any other consulting firms to ask for their input because we don't want that input yet.
The actuary and the consultant are the two big guns and two things that we rely on, or I rely on as a board, besides in-house staff, are those two people. So as part of the investment committee, not knowing as a neophyte back when it was done years ago, now after 10 or 12 years of experience, the question that I have is it appropriate for members of the investment committee to sit with staff as they are interviewing the finalists, not as a voting member of that, but just to hear the differences between the candidate? I have no idea what the differences are between, and nor would I have access to read the replies to the individuals. But if I wanted to do that, to see the tone, the tenor, the depth, all of that sort of thing, certainly, would that be appropriate or out of place for a board member to sit and hear that? And I'm asking that especially of board members and also of staff.
The entire process is going to be open. So if there's anybody that wants to join in any of the initial interviews, are more than welcome to. It's all published. It's going to be published. The responses are going to be published. We will make them available to you. So in the amount that you want to be involved in the initial process, you're more than welcome to be.
Having no idea of your schedule, how many finalists there'd be, I don't know that I would want to drive to Jackson to sit through these, but I might want to read the tenor of all the responses or the differing responses in some manner. So if we just know that since this is a product of this committee may have interest in it.
Well, in the past, I know with actuaries, and if I'm not mistaken, we did with investment consultants, you brought the top 2 or 3 to the committee. to actually, to be interviewed.
Well,
And I don't know that that's what we want to do, what your recommend, there may be enough gap in the difference that there's no, that you don't want to do, that there's no reason to. But if they're close, I think, if anything, I know in the past, with the actuarial firms, we had 3 of them that actually came and presented the last time.
Yes.
When CAVMAC, and we chose CAVMAC out of the 3, but we had a group from Louisiana and one other group, I forget the other one, that all 3 came.
And that may be enough for me if I have read their responses and looked at that, because, we stopped on the managers bringing in several managers. We left that to staff, and then you just brought us the finalists like today. I mean, we didn't see any others, but this is one of the 2 major, and I see that as extremely important, and that we may need to decide something differently.
But like I said, we may want them to have, particularly if you come in and and the gap, there's not a very big gap between 1, 2, and 3 and whatever.
Well, what we could do, first let me just say, I appreciate where you're coming from and be happy to help try to facilitate, whatever the best way that's preferred or agreeable. No problem there. What we could possibly do is wait and see what the response looks like, how many, and so on and so forth, and then give that information, share it with you, and then we could determine the next steps there. However,
First hired Callan, there weren't a lot of them out there. When Mercer got out, if I'm not mistaken, there weren't a lot of them.
Well,
of folks who capable of out there.
We did get a lot of responses, but the problem is the responses we got, when they went through and answered the questionnaire for minimum requirements, most of them didn't meet most of the minimum requirements, so it kind of excluded them. I mean, we have the same process in place because we want to make sure that we're getting a consultant in front of us that can actually consult on a plan like ours. So there will probably be quite a few responses.
well, the questions, as you can see, are not questions about the RFP per se. It's the process surrounding that. I'm ready to vote that we go forward with this. I just want to make sure that the investment committee, since we're responsible and the recommendation is going to be coming out of this committee, that we're comfortable, because, and I'm like, Bill, I think we need to see all of the finalists, even if we have to do it on a special day. We need to see them all, because we need to know how they communicate. Now, if they don't communicate well to me, that would be an issue. And if they don't talk to me, and I'm not a financial guy, in a way that I can understand, that's a problem to me. But I can only see that when I get to sit here, listen to them, and ask them a question, or look them in the eye, and that sort of thing. So I've asked all of my questions.
I'm at the will and pleasure of these trustees. So if you want to see the top 3, I am completely for that. If you only want to see the top 1, I'm completely for that.
Let's see who we get and how many we get.
Why don't I just stay in the mix, so to speak, and then maybe pass those
When you start weeding out the folks.
mandatory qualifications, that may be the first step, but I think before that, I don't know that it's not just wasting the board's time and y'all's us being in it possibly. Before that mandatory qualifications piece they're over that hurdle. Mm-hmm. Which is, I think, what everybody's kind of saying. And then it's just a question of whether there's a lot of distance between those. If there are 5 of them, well, there may be 2 that are great, y'all think. And so no need in having 5, just pick the top 2 and let's say that's it, that type of thing.
But I would like to know, okay, we got 15 responses and 10 of them didn't meet the minimum qualifications. And just say now we're gonna look at these others. And then when you start doing your in-house stuff, if there's a possibility that some of us can come and can sit and listen, when you're gonna be asking the questions you're gonna ask, I wouldn't have a clue about it, but I might wanna hear the question and the response. And did I feel like they were giving an honest, straightforward response? And at some point I could say, you know, it seemed like they were hedging a little bit here. How did you feel about that question? You know, but that's just me. So I'm ready to do what we came to do, which was to go forward.
I'll make the motion to authorize the RFP.
We have a motion. Do we have a second?
Second.
We've got a motion and a second. Any further discussion on the RFP? All in favor, say aye. Aye. Those opposed? There are none. We have made the motion to proceed with the RFP.
Thank you, Mr. Chair.
So we're done with that. Now let's go back and take up our mid and large cap manager presentations.
Thank you.
Okay, who's coming in?
Okay, we have 3 asset managers coming in today. We have, they're all domestic managers. We have 2 mid-cap managers and a large cap manager. The large cap manager growth manager, and Victory is a value manager. So unless there is any questions for me on what they do, I am going to get them in here and let them go over their portfolios with you.
What order are they going to come in?
They're going to come in, I believe Artisan is going to come first, then we will hear from Victory, and then from Eagle Capital.
I just need to know to draw them up on my computer here, get them in order.
Few degrees warmer than Milwaukee, but we had hoped you could do a little better for us.
Just 1 week late, you know.
We're going to give you several minutes to make your presentation, and about 20 minutes or so, and then allow some time for us to ask questions if there are any. I'm going to turn it over to you, and we do have your materials in front of us.
Outstanding. Well, thank you all very much. It's good to be here, good to see everybody. My name's Floyd Dukes, and I'm one of the partners in the institutional group at Artisan Partners. And I want to begin by thanking the board and really the state of Mississippi for a partnership that has gone for well over 20 years now. You've entrusted us with the assets that we manage for you in mid-cap growth since 2002, and we can't thank you enough for your confidence and support. To that end, I'm joined by Matt Cam on my immediate right. Matt is co-lead portfolio manager for your mid-cap growth portfolio, and on Matt's right is Jason White, the other co-lead manager. Both of these gentlemen are responsible for all the decisions that go into making the portfolio, and they will do the majority of the comments this afternoon. With that said, I did want to mention a couple of things just from a very high level that I think will be helpful. And with that in mind, if you just turn to page 1 very briefly. The first thing I wanted to say is that our firm remains very, very stable. As of year end, we had about $180 billion in total assets. The growth team managed well over $35 billion of those assets. So from a firm perspective and a team perspective, we've never been in stronger shape when it comes to our business and our ability to do what we want to do. We have absolutely held on to and maintained our focus on high value added strategies. All of our key people remain in place. And so in terms of stability, I think the firm gets very, very high marks. That same degree of stability holds over to the investment team, which is listed on page 3. As I mentioned, Matt and Jason are here today. They do run the portfolio, manage the strategy. And if there are no questions about the team, I'll turn it over to Matt to make a couple of comments about our infrastructure and our personnel, and then we can get into portfolio performance.
Great. Well, what I'd share with you about the team in terms of an update is that we continue to have a strong foundation of very experienced investors, many of whom have worked together for a long time, most of our careers. And on top of that, over the last 3-4 years, we have been supplementing and refreshing that talent with some important new hires. It started in 2022 when we recruited Angela Wu to be our internet and media leader. She has had tremendous success. That's been the strongest performing part of your portfolio over the last 3 years. She has recently been promoted to portfolio manager as a sign of the impact that she has on the team. She continues to lead internet and media stock picking for us. We added 2 new industrials analysts 2-3 years ago. Francois and Judy are listed here. They really hit their stride last year, and we're executing very well in industrials today. We've got an announcement coming up soon in which we're going to be adding to our tech research talent we're excited about. And lastly, last but not least, I'll mention Jason. Jason has been a partner of mine for 23 years. He's been one of the portfolio managers on your portfolio for many years. A little over a year ago, I asked him if he would spend more of his time on the mid-cap portfolio and help and co-lead it with me. He agreed to, and I would just say he's had a very positive impact on the performance of your portfolio over the last year and a half, which I would expect to continue. So hopefully that illustrates our commitment to continuing to invest in the team to deliver strong results for you for many years into the future. On page 4 is a reminder of our investment process. I can simply say this has not changed. We continue to focus on compounding the value of the portfolio by owning companies who are experiencing positive profit growth and seeking to avoid permanent capital losses. We do that by being very selective in what we look to put into the portfolio. High quality businesses with competitive advantages who are early on in a positive profit cycle that's driven by trends and catalysts that we can research and build conviction in, and stocks trading at reasonable valuations. And we then conviction weight the portfolio so we get the most capital behind our highest confidence investments. This process has served us very well across multiple full market cycles over our nearly 30-year history, and we're confident that over the current market cycle, it'll leave us in a good place. On page 8, it's got our overall performance results. I'll make a couple high-level comments on this and then turn you over to Jason to hear a bit more about what the detail behind last year's results and our outlook going forward. If you go back a couple years to end of 2021, we had very strong short and long-term performance results at that point in time, and that's pretty much been our experience for most of our team's history. We then had a few challenging performance years following the pandemic, which we've talked to you about in the past. 2022 was a very challenging year for growth stocks when you had the pandemic end and interest rates skyrocket. And then 2024 it was more about what we didn't own. There were a couple very large positions in the Russell Midcap Growth benchmark that really went to extreme valuation levels. And the stocks that we owned just couldn't keep up with that. We stuck to what we do, looking for high quality businesses across the economy who are benefiting from strong profit cycles. And I would say that after those few challenging years, we were very encouraged by our 2025 performance results. As you can see at the top of this page, the portfolio increased 16% last year versus the Russell Midcap Growth Index, which was up just under 9%. So it felt like we were beginning to be rewarded once again for finding high-quality businesses with profit growth and reasonable valuations. We still have some work to do to put those 3 and 5 and 7 year performance comparisons back to where we expect them and where you expect them to be. But last year was a really good first step in that direction, and I would tell you that early in 2026, that performance momentum has continued, which we're encouraged to see. So I think that's the high level thoughts on performance, and then Jason, I'll turn it over to Jason.
Yep. Good afternoon. I'm gonna talk you through our performance in 2025, and then talk about our outlook and how we're positioned for that outlook going forward. And to do that, I'm going to start on page 12, please. So the biggest contributor in 2025 was communication services. That's otherwise known as internet. Matt mentioned Angela and her recent promotion to portfolio manager. She's continues to do really well. You can see internet outperformed by 3 percentage points for us last year. Spotify and DoorDash were names that we still own that were in particular significant contributors to your portfolio last year in internet. Healthcare is another area to mention. You can see it was also nearly outperformed by 3 percentage points. You can see it's our biggest overweight. You know, if we think back to April, May of 2025, a lot of that was in question, as you recall, from the tariffs and some of the most favored nation discussion that was going on in Washington, and we redoubled our efforts and really gained confidence in what we held, and that confidence turned out to pay dividends as we moved through the year. We still remain significantly overweight healthcare, and we're excited about our holdings there. Some of the contributors of note were Ascendis, Argenx, Insmed, iRhythm, which I'll be happy to discuss in more detail if you have questions later. Financials was also an area of outperformance in 2025. You see it's a relatively modest weighting in the portfolio. That outperformance came from not owning many information services companies whose business models began to become in question as artificial intelligence and the implications of that technology rolling out caused those stocks to suffer, and your portfolio benefited because we didn't own those. The other name to call out there is Robinhood, which is an investment we've held for a couple of years now, and was a significant contributor to performance in 2025. Technology, you can see, was a detractor in 2025. That was I talked about artificial intelligence and its impact on different business models. Some software holdings were impacted by that in 2025. We did a lot of work on that in the middle part of the year and reduced our exposure significantly. We are feeling like technology is on sounder ground. We exited Q4. I think that's on page 10 of your presentation, where technology outperformed by 2 percentage points in the fourth quarter as we shifted capital where profit cycles were happening. So with that, I'll get into the outlook. I'm going to stay on the same page here just because I think it helps to look at the sector weights. I'll start with technology. I talked about how we reduce software. We do own in your portfolio, about 4.5% of the portfolios in software businesses today. Those are businesses where they're not particularly big positions, where we feel they're on the right side of benefiting from artificial intelligence. But we're remaining open-minded as we continue to learn there. The other part of your technology exposure is in semiconductors and electronic hardware companies, all of which are gaining market share in their respective categories. Examples would be Lattice and Monolithic Power and Astera Labs and Pure Storage. Those companies have done quite well over the last really 9 months because they are benefiting from the build-out associated with all this capital spending you see from these big companies building out artificial intelligence. We are mindful of some of the valuation levels that they're getting to and have been trimming them back to mitigate valuation risk as they reach the upper end of where we see as fair value. And so overall, I would say technology is in a place where we're modestly overweight, and we remain flexible in our thinking as this artificial intelligence trend continues to evolve. The internet outlook, we're quite positive about the internet outlook for 2026. That was helped in part by some of these stocks pulling back in the fourth quarter of 2025. You can see they had very good performance last year, and there was some profit taking in 2025. The names that we own, we continue to like a lot, and be happy to get into those in more detail, but DoorDash and Spotify and Roblox would be examples of names that we're quite excited about and are significant holdings in your portfolio. Healthcare, I mentioned, is the largest relative overweight in your portfolio. If you break down that 25% of the portfolio that's healthcare, almost half of that is 3 positions, 3 biotech companies, all of which are early in their, they all have multiple drugs that are approved. All those drugs are in their relatively earlier phase of adoption. If you add up the total revenue of those 3, it was about $4 billion in 2025. And as we do our work and talk to doctors and diligence what we think the uptake of these new drugs will be, we think it could be nearly 20 billion exiting this decade, and that comes at very high incremental margins. So we're quite excited about that area of the portfolio. We also own the other half of that healthcare weighting is in select categories within medical devices. Here again, we own companies where they're demonstrating they're taking market share, and as they take that market share, it's accreting to their margins, so they have positive operating leverage. iRhythm, Insulet, Twist would be examples of those. And then, as Matt mentioned, we're really enthused about industrials and the progress we've made there. And if I had to just kind of subsegment that exposure for you a bit, about 8% of your portfolio is in aerospace companies. And the way we think about that is Boeing and Airbus have 8 to 10-year backlogs because their supply chains were disrupted during COVID. They're at the very early stages of improving their production schedules. And we're invested in companies that have more content on the planes or on the new engines that are attached to those planes as that production scales up. So examples there would be Woodward or RBC Bearings or FTI Aviation. The other prominent area in industrials is defense, where it's nearly 6% of your portfolio. Here we own businesses. We all know that defense budgets globally are increasing, and we're in businesses that are taking market share in critical areas. So that would be areas like space, missiles in terms of their guidance systems, nuclear technology. So L3Harris, Teledyne, BWX Technology would be examples there. I'll I'll stop there. I would just note that the portfolio in total is on page 29. And Floyd, Matt, and I will be happy to answer questions.
Okay, board members, do we have any questions here? Staff? John?
Yes, when you look at the portfolio, you talk about some of the valuations being stretched. What are the ones that you're most sensitive to in terms of getting in the upper range?
Yeah, I mentioned some of these technology businesses that are providing technology into the build-out of artificial intelligence. We're being incremental there. You know, as we look at valuation, as they get close to what we think the 12-month fair value is, we're incrementally paring back, but we also have to be honest that we have been positively surprised at the level of capital spending that's going on. And so the fundamentals of these businesses are quite strong. But we're paring that back. You know, we're exposing the portfolio to that positive profit growth and being open-minded that it could continue for a number of years, which we're forecasting through different scenarios and probability weighting to arrive at our valuation framework. But we're also mindful that in all of these cycles, they eventually end, and when they end, you know, inevitably there's an overbuild, and so we're balancing those things in terms of how we manage those positions and paring them back based on our scenario analysis and our view on valuation.
And some of your healthcare holdings you've held for quite some time, they are in the upper end of the overall allocation. Sustained confidence in those?
Yeah, you know, I think Jason framed the growth we're expecting from some of those larger positions, you know, that are essentially multiple companies who have launched breakthrough new medicines that are early on in their adoption by physicians, and have, you know, several of these have additional indications that are likely to be approved in the coming years. So the current drug is going to be used for not just one disease, but multiple. And then they have new drugs in the pipeline behind that are at varying degrees of development and being able to reach the market. And with very, I think, we've got a long history of assessing market sizes for new medicines, for risk adjusting things that are in the pipeline at an earlier stage and a little bit harder to bank on. And if we put those through our, you know, prudent way of looking at those things, we just see a lot of value creation ahead for these businesses. I mean, these are companies that I think, you know, a company like argenx or Insmed have the chance to be kind of, you know, some of the large cap pharma companies of the future. And we saw some of today's large cap pharma companies follow that same pattern. So we've got a really long history in this mid-cap portfolio of seeing the mid-cap biotech franchises who break out, what that looks like along the way, and how you can hold them for the you know, the full extent of that journey.
Other questions? We thank you all from Artisan for coming down today. Jason, Matt, Mr. Dukes, Floyd. I was trying to think, but I'll have to ask you that over there. I can't ask you. So thank y'all so much for coming down. If you got any questions for staff, they'll certainly take care of it. Charles and all, y'all. Thank you so much.
Thank you very much. Yes.
Hello, hello.
How are you all today? Well, I'm glad that you all are here and you're going to share with us all the great things about Victory Capital, right?
Sure, yes, Victory Capital, absolutely.
Okay, well, good. About 20, 25 minutes, then a few minutes for us for questions. But I'm going to turn it over to you all and introduce yourself. We do have your materials in front of us as well.
Okay, terrific. Hi, everybody. My name is Andrea Heckman. I am the Client Relationship Manager. I've recently taken over this relationship for my colleague Mike Hackett, who you may remember from before. I am not new to the firm, however. I've got about 30 years with our combined organization. And I've actually been in front of this group before for our finals presentation back in 2016, 2017. So pleasure to be back. Looking forward to working with you and Ryan's team going forward. With me today is Eric Nabin. He is a institutional portfolio manager with the Sycamore team. We manage a mid-cap value strategy for you, and we're funded back in 2022. So again, we thank you for your business at that time. There's really nothing to report from a firm level standpoint, so I'm happy to answer any questions about the parent company, Victory Capital, if you have any. But otherwise, this is your meeting, so Eric has got some prepared remarks, but if there's questions as we go, please feel free to ask and interrupt, and we're happy to take those.
Okay, thank you. Well, good afternoon. On behalf of the Sycamore Capital team, we appreciate the opportunity to present to the board this morning. To help the board understand the drivers of performance over the past several quarters, I'm going to peel back the onion and frame up the backdrop and touch on what's transpired in the market over the last few quarters. Before I dive into the details, I'll touch on the team. We are a Cincinnati-based boutique manager specializing in mid-cap value and small-cap value investing. The current regime, led by Gary Miller, our CIO, has been in place since 2004. Just from a high level, we take a do no harm approach to investing. We want to win by not losing, so we really try to protect the portfolio by limiting the number of mistakes. Collectively, we're managing about $29 billion. $22 billion is in mid-cap value, which this organization is invested in. And we have about $7 billion in our small-cap value strategy. So from the onset, I want to be blunt with the board today. The market backdrop in 2025, especially from the April lows through the end of October, was at odds with our investment approach. That is, being contrarian and building a diversified active portfolio was punished by the market. A one-dimensional and singularly focused market created meaningful stylistic headwinds for us. In 2025, the market was emotionally charged and less fundamentally driven. I've been doing this for over 20 years. Gary Miller, our CIO, has been doing this for over 35 years, and I can tell you it is difficult to remember a period when the market has been so divorced from business fundamentals. Hence, adhering to a valuation-centric fundamental approach and building a diversified portfolio of quality-biased companies has not been rewarded. Rather, the market has rewarded high-flying themes: AI, quantum computing, crypto, rare earth, etc., with little regard for valuation or their speculative nature. However, as you think about performance over the last year to 2 years, it's really not just one factor for us. It's a mosaic of factors that explain the current performance woes, which I'll touch on. The first one, and really what laid the foundation for our performance headwinds over the last couple of years, was laid in 2022. It was a banner year for our strategy. When the Fed was behind the curve and had to embark on an aggressive tightening campaign in March of 2022, there was a massive rotation into quality. It was essentially the perfect storm for our portfolio. A quality-tilted portfolio benefited from a rotation into quality. In fact, our mid-cap value strategy was down 2%. Our respective benchmark, which is the Russell Mid-Cap Value, was down 12%. So the portfolio did what you would expect a quality-biased portfolio to do. It protected the downside. Now, sticking to our valuation discipline, we sold momentum. We sold momentum too early and leaned into pockets of the economy where there was weak fundamentals. Historically, as a value investor, you got rewarded by doing that. That's not been the case since the release of ChatGPT. Second, we've had some self-inflicted wounds. We've been too patient with fundamental underperformers in the portfolio. We've relied too heavily on prior trough multiples, recessionary trough multiples for our worst case scenario and for respective holdings. And historically, what's made this market so different over the last couple of years, historically, you would reach a point of fatigue. You would run out of sellers in a respective stock. That's not the case in this market. We're seeing valuations getting overdone both to the upside and to the downside, essentially in both directions. Third, as I mentioned earlier to the board, we take a do no harm approach to investing. Well, unfortunately, I'm going to be very frank with the board. We haven't done necessarily a good job over the last year. We've had some poor stock selection, specifically in technology and industrials and materials. Now, some of that was related to the tariff regime that we saw earlier in 2025, which impacted some of the stocks in these cyclical sectors. Fourth, we faced, like I mentioned, meaningful stylistic headwinds. Last year, especially the period between April and October, was led by risk, momentum, and growth. Those were atop of the leaderboard, and quality and value were neglected. There's essentially no sponsorship in the market for a discount to intrinsic value, and that's the central tenet of what we do. High multiple stocks have continued to get rewarded. And then finally, what I would mention to this board is severe concentration in both small and mid-cap equities. Crowding into what's working has become acceptable. So not owning certain stocks, especially the winners, has had a notable impact on relative performance. In fact, just for reference for the board, top 25 contributors to the Russell Midcap Value last year explained 55% of the benchmark's return. Did we have exposure to some of those? Yes, we did. But momentum kicked us out of those names because we are a valuation-centric investment manager. To also help the board understand the setup in 2025, it's best to deconstruct the year into various regimes. The first regime was from the beginning of the year, January 1st, through inauguration. The portfolio did fine. You had coming into the year, you had historic confidence, back-to-back years of 20-plus returns for the U.S. equity market, very impressive, clashing with historic uncertainty at the time of inauguration when there was a frenzy of policies that injected a lot of uncertainty into the equity market. Now, the portfolio did fine, held up better. From inauguration through the peak uncertainty period on April 8th, your portfolio is down about 17%. I'm sorry, 16.5%. The benchmark was down 17%. So held up better during that drawdown. What really hurt us, and when we faced the most wind in our face, was the period between April 8th and the end of October. In that 7-month period, your portfolio was up 16% and the Russell Midcap Value was up 26.1. So we were roughly 10% behind. Now, a few points on that period. The volatility and momentum regimes were at extremes. We've only observed these since 1990 on several occasions. During the dot-com era, during the GFC, and at the onset of COVID. Now, what makes this period interesting between April and October is the drawdown was nowhere near as severe as those prior three periods. If you think about the drawdown that we saw from March of 2000 through October of 2002, it was a 50% drawdown. The drawdown that we saw during the GFC was about a 57% drawdown. And the drawdown that we saw at the onset of COVID was at about a 34% drawdown. The drawdown that we saw from January 21st through April 8th of 2025 was about 19%. Yet, the outperformance of momentum and volatility, which is generally reserved for these big drawdown periods for recessionary times, and we weren't in a recession or a bear market between April and October of 2025, yet that volatility and momentum worked just as hard, which was a major stylistic headwind for our portfolio. And then we had regime 4, November and December, when the investment community started to ask questions about AI, the AI trade. Where's the ROI going to come from? Where's the return on investment? We're starting to see some of the balance sheet put on leverage. And also, we're starting to see some pushback from certain municipalities about data center build out in their own turf. And so, given the jitters around the AI trade, there was a rotation out of some of these hot topic or hot themes into areas of the market that were being neglected. And the performance of the portfolio reflected that. So for November and December, the portfolio was up 3.2% versus the Russell Midcap Value, which was up 2.5%. So roughly 70 basis points ahead. And we've seen the continuation of that year to date. You've seen disruption concerns around AI hit certain areas of the market, and you've seen the market broaden out, which is good for a manager that is tasked with building a diversified active portfolio. And your performance through yesterday, the year to date, up 8.9% versus the Russell Midcap Value up 7.7%. And what do we attribute that to? A rotation out of some of these factors like risk, like momentum, and into areas like quality and growth. And that's why that's being reflected in the current performance. So in summary, the recent underperformance is a result of a mosaic of factors. Again, one, meaningful relative outperformance in 22, which resulted in the team selling momentum too early. Two, some self-inflicted wounds, which we talked about. And then finally, the market dynamics were at odds with our investment approach in 2025, especially for the 7th-month period between April and October. So with that being said, those are my prepared remarks for the board today. Happy to take questions.
Questions from board members?
That report, do you perceive a turnaround on the positive side as we go forward?
Yes, sir. So anytime the market is broadening out and not focused on one specific economic segment, that's good for the portfolio. Because we're finding opportunities across different economic sectors, in industrials, in materials, in healthcare, in consumer staples. And really last year, the market was only focused on one or two themes. And if you weren't exposed to those one or two themes, you were essentially punished by the market. The other thing I will say, there are some green shoots. The ISM, which is a measure of the basically manufacturing here in the US, has really been contracting for about 3 years since November of 22. And meaning it's been under 50. It's come in under 50. And that generally means that the ISM is contracting. We got a print about 2 to 3 weeks ago, which actually showed that the ISM is above 50 for the first time in 3 years. And which means that the economy is broadening. It's expanding beyond just the one area, which is, data center build out and the infrastructure build out for AI. So that's good for mid-cap value. That's good for small-cap value as the economy broadens out. So we're fairly optimistic on the asset class. The other thing is you have extreme concentration and you still have a valuation discount relative to large cap. Specifically for the S&P, for example, 7 stocks make up a third of that benchmark. So as I speak to investors and I attend a lot of these board meetings, and I ask consultants, what's keeping them up at night? One of the feedback I get is the extreme concentration in the equity market, especially in large cap. So we're fairly optimistic, cautiously optimistic on the asset class, and as long as the market continues to broaden, it should be a tailwind for the portfolio.
I was going to follow up with what about the next 6 months? It seems to have turned just a little bit. Do you anticipate that? And you said that was going to be a tailwind, so I'm assuming that you're looking good for the next few months.
Well, I would hope so. Yeah. But I will be honest. Our crystal ball is broken like everybody else's on Wall Street. And the reason I say that is the market has become so thematic that almost every week there's a prevailing theme, and that theme basically takes shape and then impacts a lot of those companies that are linked to that theme. And so for us, we're not thematic investors. What we focus on is basically buying and putting the best companies into the portfolio. Balance sheet, good sustainable business model, long-term winners, compounders. And so am I optimistic over the next 6 months? So far year to date, the broadening of the economy and the broadening of the market gives us reason to be optimistic. But the market could turn on a dime and you can get that AI trade unfolding once again and the market becoming concentrated again, and that would generally be a headwind for us.
So has the tariff issue had any direct impact on any of your business? And now tell us a little bit about and what the Supreme Court's decision and how you anticipate that's going to have an impact.
So at the onset, it did. I think the investment community was looking at what happened in 2018 under Trump 1.0 and basically in first quarter and second quarter of 2018 and thought that the tariffs are going to be somewhere along those lines. The tariffs were much more severe, much more broad. So anything in our portfolio that touched any of the tariff countries, whether you had 1% exposure or 10% exposure, your stock was impacted almost the same. And we did an analysis. So if you were a company in our portfolio and you had a foreign revenue source, or you touched some of the tariff countries through the supply chain, your stock was penalized much more so than if you were domestically focused. The recent decision by the court, we're still kind of figuring that out, but that injects another element of uncertainty. Now, what we've seen since that is some of the more cyclical names have actually bounced over the last couple of days in the portfolio because there's some relief on that tariff front, right? And so that's a short-term impact. So I really can't speak on the Supreme Court's decision, how it will ultimately impact the portfolio long-term. But what I would tell you, and we were generally surprised, management teams, most of them, given the balance sheet strength and they were plush with cash, a lot of them were able to navigate the tariff regime, and that became a moot point really by the third quarter of last year. It was a big topic as we spoke to management teams in the first quarter, the second quarter, and by the time November, December hit, it was almost a moot point for some of these management teams because they figured out how to navigate. And especially mid-cap companies that have their tentacles spread throughout the world, they can pivot fairly quickly.
Okay. Other questions? Yes.
So as these regimes change, your thought process, are you looking at different things on the balance sheet? Are you more focused on free cash flow? Or are you focused on some other valuation metric? Or are you shifting more amongst sectors to capture those whatever regime you're in? How does your team change their thought process in this?
So that's a good question. So profitability is always going to be the key focus for us. So if you were to dissect our portfolio and you think about the exposures that we have in our portfolio relative to our universe, we're always going to be building a portfolio of quality biased companies. And one of the key quality components we look at is profitability. So ROE, net income stability, free cash flow generation. So that's never going to go away. The way that we're adjusting our thinking is the market is punishing you to be too early as a value investor. So instead of being 4 to 6 quarters early, now we have to think about, okay, that's an opportunity cost. Maybe we have to be 3 quarters early. And then the other thing is, historically, being contrarian and being early, you got rewarded. Now you're actually getting punished by being too early. So we have to have a line of sight into the fundamental inflection. So that earnings fundamental inflection. It has to be, we got to be able to kind of identify it and say, this is a couple quarters out, not a couple years out. The other thing I would tell you, in terms of what we're doing around the fringes, I mean, we're not, to be able to keep up in that environment between April 8th and the end of October last year, we would have had to overhaul our process. I mean, that's how severe the stylistic headwinds were. And to give you a data point, we deconstructed between April 8th and end of October, how much of it was stock selection, how much of it was factor headwinds. 2/3 of it was factor headwinds, things that are out of our control, right? The other thing that we're doing on the fringes is we're actually going in at smaller weights now. So that way, if the thesis falls apart, or the fundamental inflection doesn't happen, the earnings power that we thought the company was going to be able to achieve does not happen, then we can unwind the position quicker, right? Without the undue pressure on the stock. But in terms to going back to your original question, it's a long way. I mean, quality exposure is going to be a central tenet to the portfolio. And building a portfolio of quality businesses is what we do. And that means we're going to continue to screen higher than the respective universe on these quality factors. So think about, like I said, profitability, net income stability, free cash flow generation, and balance sheet strength. We're just not willing to push the risk envelope from a balance sheet perspective to be able to, make up for some of the performance headwinds when it's a risk-on regime, it's a beta-induced regime.
So in that beta-induced regime, how do you know you're not in a value trap?
So that's also a good question. It's really through our bottom-up fundamental work, and we don't focus purely on statistical cheapness. So, I mean, if you have two stocks, one is trading at 10 PE, the other one's trading at 14 PE, we're not going to automatically put the 10 PE stock in the portfolio. We're willing to pay up. The question is, for us, is what are the levers that management has? We have to be able to identify certain levers that management has to create value, right? And we want those levers to be under the control of management. It could be a change of strategic direction. It could be divesting a non-core asset. It could be integrating an acquisition they made, and finally, things are going in the right direction. And so we don't purely just focus on classic valuation metrics. We approach the opportunity set, the mid-cap value space, from an intrinsic value perspective. So we evaluate companies holistically. We talk to the management team, what motivates management, try to understand their end markets, competitors, suppliers, why do they have a competitive advantage, and then three is to be able to identify what are those levers that management has versus just focusing purely, look, this stock is trading at a discount, it's a value stock, let's put it in the portfolio.
Other questions? Go ahead.
Can you spend a moment just talking about the change to the portfolio, names, exiting, names that you're bringing in? So what the turnover was 58%.
Yeah.
How does that look compared to historically?
So it was high.
Yep.
And the reason it's high because, John, I mean, one of the things that's we've discovered just over the last year or so is valuations are getting done both to the upside and downside. Meaning that if you have momentum in your stock right now, and historically you've peaked at 18 times, let's say an 18 times multiple. Well, now some of those stocks that are linked to the prevailing themes are trading at 28 times. So we're seeing peak on peak valuations. And then on the flip side of that, if you're a commodity chemical company, you've got a great balance sheet, you're pretty stable free cash flow model, like you're almost like a consumer staple company, and you're in the penalty box because you don't touch any of these prevailing theme, and your recession multiple is 1 times book that we saw during the GFC in 2007, 2008. Now you're trading at 0.6, 0.7 times that book. So you're talking about valuations now on the other side of that are trading on trough multiples. That's the valuation divergence that we've seen, right? So in the portfolio, what we had to do, I mean, one, part of the reason you saw turnover as being high is at the onset of the tariff regime last year in February and March, we didn't really have any clarity of how that's going to all shake out, right? So we had to go through the portfolio and say, what stocks are impacted the most? And we had to try to get out of those positions because it was out of the control of management. And we had a couple of those that were big detractors. So, and then the stocks is you're getting punished right now to hold on to stocks that are that are going through short-term fundamental challenges, which historically, as a value investor, you try to exploit that. Now the market is telling you if you're going to hold on to those, or you're going to be too early in those names, we're going to punish you. So we had to unwind some of those positions, and we're finding opportunities still in cyclical areas of the market that don't necessarily, touch some of these prevailing themes. But there's a more clarity into their fundamental outlook, right? I mean, as a value investor, you're always investing into lack of fundamental clarity. Because if you had perfect clarity, it wouldn't be called investing. And so what we're trying to do, I mean, the best way I can frame it up to the board here, I mean, as a value investor, you got to kiss a few toads before you find your prince. And the goal for us is when we kiss those toads, they don't work hard against the portfolio. In this market, being too early, you're getting punished. And so that's part of the reason why you saw turnover around 58, 60%. Historically, it's around 35. We feel pretty good about where the portfolio is today. I mean, we're still adding in sectors where there's significant dislocation. So industrials, materials, healthcare, some consumer discretionary, the areas that we generally are kind of avoiding are areas that have run up. So like semiconductor equipment, stuff that's touching and has already been pricing in the AI build out, and then REITs and utilities. Thank you.
Other questions? Staff? Andrea, Eric, we appreciate y'all coming and
Thank
sharing. Anything you want to leave with us as you head back today?
I think we're good. We thank you very much for your confidence. We look forward to a long-standing partnership with you.
Thank you so much. Y'all
Thank
have
you.
a great rest of the day.
Thank you. You too.
Thanks for having us.
Thank you.
Did it fall? Yeah, I got it. To animate it. Thank you.
You know, it's always good when you come here because I like to say the eagle has landed so that you're here. So,
It's a little bit more challenging this time around with the storm in that up
we're
north.
going to allow you an opportunity to explain then.
Go.
So we're going to turn it over to you, about 20 minutes or so, and then some questions at the end.
Okay.
We do have all your materials in front of us.
Good, good. Well, nice to see everyone again. I'm Will Highland, senior member of the client team and partner of Eagle Capital. And on behalf of all of us at Eagle, thank you for being a valued, very, very important client for over 20 years. So we really do appreciate the relationship and the longevity. What I'll do today is Just a few minutes on Eagle Capital. By chance, there's some new folks listening and in the audience, and then touch on performance, the portfolio, and then outlook. Kind of talk about what we're seeing and thinking in terms of the markets. We don't have a crystal ball, but just to share some thoughts. So Eagle Capital, we've been in business for 37 years. We're a concentrated public equity manager. Think of three things: duration, concentration, and most importantly, valuation. So in terms of concentration, we hold 25 to 30 stocks, sometimes a little bit above 30 positions. We'll go up to 35% per sector, 10% per position. Cash is topped out at 10%. And turnover is generally in the 10 to 20% range. So we're kind of long-term managers. We're not a traditional deep value manager, nor are we a growth manager. But when people look at our portfolio, they kind of scratch their head and say, wait a minute, this is an eclectic mix. How do you square that circle? So what we're trying to do is, over a long period of time, beat the market by putting up double-digit returns in as many years as possible. And if you look at the history of Eagle over 37 years on a rolling 10-year return basis, and we do think the way you beat the market is by thinking long-term. And that's even become more pronounced as the average stock holding period continues to diminish and the world is swirling in information 24/7. So what we're trying to do is put up double-digit returns. And if you look at the history of Eagle over 37 years, we have done that about 75% of the time. The two benchmarks, the Russell 1000 Value and the S&P 500, about 50% of the time. So regardless of what the market's doing, we're holding to our strategy. And as I said, it's not distinctly growth or distinctly value, but we do correlate with value. And as I said, valuation matters the most to us. So what our investment team is trying to do is we're looking out 5 years. That's kind of the bullseye or the sweet spot of our analysis. And we're trying to find good to great businesses that over the 5 years, their profits will compound at 10% or better. So as you know, the market's a voting machine. Every day at 4 p.m., it casts its vote. And so the multiple ascribed to a stock is determined by the emotion of the market. We can't predict that, and we're not going to bet on that. If you look at the history of Eagle, the majority of our contribution or appreciation of your capital has come on the back of profit growth by the positions in the portfolio. That we have far more confidence in predicting, analyzing it, and estimating in what it will be 5 years out. So we're basically looking for positions that will compound in the mid-teens or better in terms of their operating profit. And the multiples, the market will decide that. We have an assumption, we have a thought on that, but it's not on the back of wishful thinking of multiple expansion. So with that framework, we end up with a portfolio that can have something like Alcoa, managed care companies, banks, energy, trading at single-digit multiples. At the same time, we can have technology companies that some people would refer to as growth businesses, Meta, Microsoft, Amazon, and so on. And so by not being style constrained, but yet letting valuation always drive our thinking, so we're protecting your capital and providing downside protection, we think we can beat the market over a long period of time. So that's Eagle Capital in a nutshell. In terms of the structure of Eagle, we're still the same. There's 45 of us in one office in New York, one product. There's no plan B. It's all on this strategy. So everyone at Eagle is focused on your important capital. So if there's no questions on Eagle Capital, I'll move on to performance. In terms of performance, over the past 2 years, we've been pretty much in line with the S&P 500, right around 20% or so, compounding per year. If you open that up to the past 3 years, it's around 27% per year that we've compounded. So we all know we've been spoiled the past 3 years. That's not normal. We've had probably a confluence of 3 elements, a lot of stimulus over the past handful of years because of COVID and just the government in general. Number 2 would be in terms of the volatility and the shocks that we've come through, bouncing back from those, being COVID in 2022. And then lastly now, but not least, you have AI, which is driving the markets. So we've had a very unusual market that has become very, very concentrated. And so over the past couple of years, you've had about 70% of the return of the S&P 500 driven by the top 10 stocks. Contrast that with Eagle Capital, and about 30% of your return has come from those top 10 stocks. In fact, we've never owned Apple, NVIDIA, or Tesla. Now, some might say, well, you should have, but it didn't fit our framework, where valuation really matters to us. So in allowing us to work with you folks and manage your important capital, what you are getting is a differentiated return stream that we would argue provides a better risk-adjusted return. We do not look like the market. The beta of the portfolio of the past couple of years has been about 0.85. Right now, the portfolio sits at about a 20%, pardon me, about a 20% discount to the S&P 500 on a PE basis, and yet we've kept up over the past couple of years, and over the past 3 years, we're about 15% ahead of the S&P 500 on a cumulative basis in total. So that unique perspective in not being too style constrained, but letting valuation drive our behavior, has provided what we think is a solid return in a time of extreme volatility, and also an unusual time where you've had record narrowness in the market. And we actually like the prospects of our portfolio and your capital looking forward. It's inevitable that the market will broaden out. The narrowness of the market will not continue. We all know it will end. We don't know when. And at some point, we think we are better prepared for that because we are not dependent on the top 10 stocks. You folks no doubt have passive exposure. Passive equity exposure probably belongs in every portfolio lineup. We are the antidote or an alternative to that, and we think when the market begins to broaden out, our opportunity set will become that much richer. So that's how we're thinking about performance in terms of the portfolio over the past couple of years. There's a slide in the presentation that shows active share. It's page 21. Active share in a nutshell is how does a manager's portfolio look relative to the market? You're not paying us to mimic or be the market. You're paying us to beat the market on a better risk-adjusted means or way, and that means to look different than the market. So you notice on that slide, the average large cap manager is well below where Eagle is, but the most important, which has always been the case, given our concentrated strategy and how we think about markets, the public equity market, is over the past couple of years, our active share has begun to rise. And that's a byproduct or output. We don't aim for it, come in one day and say we're going to aim for X% active share. That is a consequence of us being valuation driven and protecting your capital. So we have been trimming some of the more expensive positions in the portfolio, such as Alphabet. Meta was as much as 8 or 9%, now it's 2%. So we've been trimming the more expensive positions. We've exited a number of positions that have worked well for you folks over the past handful of years, such as Visa, Netflix, GE Vernova, Wells Fargo, and a few others that we've exited. And then in terms of what we've taken that capital and deployed it into, it's a variety of new positions. And again, it speaks to our style of being very eclectic and looking for companies that are good to great, that can grow their profits mid-teens or better over 5 years' time. So we've added capital to managed care, which is going through an underwriting cycle. We've added some to energy. Cable has struggled of late, and a few others. Then a number of new positions are Estee Lauder, Lennar, the home builder we bought during April of last year, first time we've ever owned a home builder. Martin Marietta, Vulcan Materials, Danaher. So it's an unusual mix of businesses. It's not as though we found a lot of opportunity in one sector or subsector. So that's where we've gone with the capital. In terms of how we think about the markets and looking forward, there's page 24 in the presentation shows the performance of Eagle Capital over time, over the history of Eagle, relative to the S&P 500 performance, broken up into four kind of quadrants or categories or corridors of valuation. We all know the S&P 500 is very expensive at this point, 20 to 25 times forward earnings. Obviously, we all know that forward prospective returns are probably going to be lower than the 20, 25, 27% I spoke of at the outset. So what we are doing is being ever mindful of valuation. And on that slide, it shows our performance. And when the market is between 20 and 25 times, Eagle has done exceptionally well over the 37 years of Eagle. We've notably outperformed. And I emphasize that because at this point, we came through 15 years ago of a time when the cost of money collapsed with the financial crisis. At the same time, you had the commercialization of the internet, which created these, what I call generational businesses. I'm not retiring anytime soon, but I doubt I'll ever see them again in my career. Amazon, Meta, and so on, where they commercialized the internet, the greatest invention of mankind yet. So that has powered the market for the past 10, 15 years. Now, AI is maybe one more leg of that. But, you know, the odds of that continuing on for an extended period of time are, you know, we're skeptical of it, right? You've had that, you've had a lot of fiscal stimulus, and you've had pent-up demand because of COVID that has now been somewhat met or exhausted. So we're being a little bit more cautious in terms of your capital. That's why the portfolio is at a notable discount to the S&P 500. You're seeing a mix of businesses in there. There's not a lot of technology. There's a number of traditional industries. And as we know, over the past month or two, the market's struggling with how disruptive will AI be to certain businesses. Well, we own a home builder. Won't be disruptive there. We own managed care. It'll probably improve their efficiency. We own aggregates companies that sell rocks. So, and we own some technology. So we think at this point, our portfolio has a lot of valuation support. We see a lot of operating profit growth from all our positions over the next 5 years, and it's at a notable discount to the S&P 500. And we're not too far off sides. We're participating in the AI excitement when it occurs, and a few of those we have exited already. And we have traditional businesses that are durable and will be here for, you know, many, many decades to come, that are kind of left aside by the market. So, so we think at this point there's a real interesting opportunity set looking forward for managers such as us, where we'll go to any sectors and we're ever focused on valuation. And at some point when the market ends this narrowness, we think we'll be well positioned to thrive in a period like that, where we probably won't see 20% returns. We may or may not even see 15%. But we do like our prospects for producing alpha much more so over the next 5 years than we've seen over the last 5 years. So.
We have questions.
Just out of curiosity, what are you guys seeing in Comcast? I mean, traditional media is kind of falling apart. What is it?
Yeah, I think certainly every manager has strong traits, and every manager has, you know, a weakness or two, like we all do as individuals. So Comcast, we know very, very well. We've owned it at different points in time over 20 years. And so we know the businesses that they have very well. At one time, maybe not now, but one time last year, it was one of the cheapest stocks in the S&P 500. So it was very, very cheap. So they are struggling with people not watching shows through their cable business, right? And so what they're trying to do is entice customers to use them for cell phone service and obviously continue to use them for broadband service. And those businesses are growing, and they're good businesses. They also have theme parks and entertainment, and they do have some more theme parks and entertainment assets that are coming online over the next 2-3 years. So you have a stock that's trading about 5 or 6 times EBITDA. So it's very, very cheap, an extremely experienced management team with some good underlying steady assets. So it's detracted from performance over the past couple of years, but we do like the prospects, certainly within the composition of the portfolio. Might consider it to be a little bit of ballast in the bottom of the boat, right? We don't buy utilities or REITs, things that might provide stability in uncertain times. Whereas something like cable is very cheap. We do think the profits could inflect over the coming years, which is why we still hold it. And it has a lot of valuation support, so that's kind of where we are.
Thank you.
Go ahead.
You mentioned at the beginning that you were looking for 10% growth annually over 5 years. Is that right? Something along those lines?
So the markets have compounded around 8% historically, right? So our kind of, the way we look at it is if we can put up 10% or better in the majority of years, we think we can beat the market. Certainly the past 5 years, it's been way beyond that.
So in your selection process, you're looking for similar growth in the individual companies that you buy. Is this just top line growth? Is it EPS? Is it, what are the major metrics that you're looking for in that, without giving away your secret?
Sure, yeah. It's all in the execution, so there's not, it's as much as the investment team, but the way it works is, think of kind of a ladder, and 15% being the middle of it. For a new position to come in, it generally has to have high teens, 5-year compounding profit growth, right? We don't know the business. In most cases, it might be a repeat position for us. So when existing positions drift down towards 10%, those are the ones that we'll look at for capital, if we find something else that we'd like to add to the portfolio. So in the case of Netflix, we exited that about 1.5 years ago. Great business, great company. The market had basically said, okay, we thought it was fully valued. And the IRR had drifted down towards 10%, give or take. So at that point, we had other interesting positions that we thought could grow their profits mid-teens or better. So that became a source of capital for something that's better, that can grow 15% or better. And those aren't firm numbers, but that's the general numbers over time. And so we will get some things wrong, and some things may take longer to materialize than we had expected. So the past 10 years, and certainly the history of the firm, we have grown capital greater than 10%. But the markets historically have been 8 or 9. So that's why I said 10, but we think we have done better. So it's not as though if something's 10% or better, it automatically would make it into the portfolio. To make it into the portfolio, it's generally mid-teens or better for an IRR.
Staff? Buddy? Board? Well then, Will, we thank you for coming, sharing with us today, and hope that you have a safe trip back home, and look forward to the next time you come and share with us.
Thank you all for being a valued client. We really do appreciate it.
Thank you so much. That's good. I've already swapped over. You're good. Just right there.
In the miscellaneous updates, you'll find the Israeli Support Act of 2019, as well as the Iran Divestment Act of 2015. These are just informational, or nothing's going to be divested. No funds have been made, so no action needs to be taken on these two items. Unless there's any questions, I'm going to move on. The next item is just an update from Artisan Partners, but Matt Kahn had already gone over that in his presentation about Angela Wu being promoted to co-lead portfolio manager. Let's see here. The next item is from Sycamore Capital, Victory Capital. Jeffrey Gaff announced that he is going to be retiring effective April 3rd of 26. Portfolio managers Mike Rodarte and Jason Brown that have been working alongside Jeff since 2006 are going to still be in place. So no concerns about those issues. And then the last two updates are from Lazard, just changes up a level teams, nothing to do necessarily with our portfolios. So unless there's any questions on any of these, I will conclude.
The only question I had was about the Iran divestment.
Yes, sir.
Since that involved Venezuela, and we're in control of that, that's kind of a double whammy, isn't it? I mean, I wouldn't know whether to put it on there or not, since we control all their oil coming out, and that's the.
Well, this company, it's based on a list that DFA produces, okay. And it just happens to be that this company is in the portfolio, so we report.
We report what we got that's on the list, but we don't have to do anything if it's producing. Is that right?
Well, we don't have to do anything if there's no funds produced to do something with it.
Okay.
There's basically what we refer to as a fiduciary clause or provision in the law. There's a short summary paragraph at the bottom that kind of reads that, but it talks about it unless there's funding provided for the lost opportunity cost, transactional cost, or to reimburse the portfolio, something to that effect. And as he mentioned, the list itself is created by DFA.
Anything else?
I have nothing else.
Nothing else. Just thank you for the time today, and then 10 o'clock in the morning.
10 o'clock in the morning, Investment Committee is adjourned. Thank you all so much.
Thank you, sir.